now start question number 1A from our January 2025 examination paper. This question is on accounting standard 20, earnings per share. A very good start, beautiful question. I will definitely not call any of these questions in your material as easy ones because they have their own level of complexity or trick involved, and it is very different for us to sit here in the classroom and then judge from what people would have actually gone through in the examination hall. So don't expect any comment from me. Paper was easy, difficult, lengthy, moderate. Paper was good. Let's see. XYZ Limited has provided you the following information as on 31st of March 2024. So net profit after tax is 31 lakh 20. Number of shares as on 31st of March 2024 is 8 lakh. When do they want us to compute? See, 31st of March 2024. So end of the year, number of shares is 8 lakh. This is not weighted average number of shares. Number of shares is 8 lakh at the end. So can I do 31 lakh 20,000 by 8? I can do 31 lakh 20,000 by 8 lakh if 8 lakh was the shares outstanding throughout the year. Do we know that it is 8 lakh throughout the year? We don't know. So let's not judge. Let's wait till the end of the problem. So there is average fair value of one equity share. They've given fair value. This is for the purpose of diluted EPS. ESOPs are there outstanding. Its fair value is 25. The price at which the shares have been allotted to these employees, excise price is 20. Fair value is 25. Meaning in the market, if someone has to buy the share, it will be given to them at what price? 25. But if our employees have to buy, what price do we collect from them? 20. How many shares can our employee buy? 80,000. So we would have to identify cash portion and non-cash portion in this. I will do 80,000 into 20. That is the money our employees will pay. How much is 80,000 into 20? 16 lakh. 16 lakh rupees is collected from our employees. But if they were not our employees, for each share we should have collected 25. Do 16 lakh by 25. What do we get? 64,000 shares should be given to them. But we gave them how many? 80,000. I'll repeat. For 20 rupees collected against 80,000 options, 16 lakh rupees is taken from employees. If you would have given them at the fair value of 25, we were supposed to give them 64,000 shares. But we gave them 80,000 shares. We gave them 16,000 shares extra. That 16,000 shares extra is not yet given. Options are still outstanding. Whenever employees exercise their option, we are going to give 16,000 shares free without collecting cash consideration. So those 16,000 are to be considered as potential equity shares in dilution. Understood? For basic EPS, this is not considered. Green color portion is only for diluted EPS. So denominator, number of shares is there, no? There I would add 16,000. How did I get 16? 80,000 shares options outstanding multiplied by 20 rupees excise price. I'll get 16 lakh rupees collected from my employees. If I divide it by 25, 64,000 shares are to be given to employees. But I'm actually giving them 80,000, which is 16,000 shares free given next year. This year it is potential shares considered in diluted EPS. After this we have debentures. These are not just debentures. These are convertible debentures. See, each debenture is convertible into 4 equity shares. There is 30 lakh rupees worth of debentures. And how much is per debenture? 100. Do 30 lakh divided by 100, we get 30,000. So can I say there are 30,000 debentures of rupees 100 each? 30,000 debentures, each debenture is convertible into 4 equity shares. 30,000 into 4, 1,20,000 is potential equity shares. Meaning they are not equity shares, but they have the potential to become equity. Illilla, but only potential is there to become equity shares. So basically 1,20,000 plus 16,000. 1,36,000 is potential equity shares which should be added to denominator. Basic EPS denominator is alva. To that we add 1,36,000 to find dilutive EPS. Got it? We'll do that computation once again. Aram se. We are not doing review. This is not a movie to do review. This is a question paper. Question paper has to be solved. Movie has to be reviewed. What are we doing? Movie solve ಮಾಡ್ತೀವಿ, question paper review ಮಾಡ್ತೀವಿ. ಮೂವಿ ಬಗ್ಗೆ 10 ನಿಮಿಷ 20 ನಿಮಿಷ ವಿಡಿಯೋ ಮಾಡ್ತಾರೆ. ಬಿಡಿ, ಚೆನ್ನಾಗಿ ಹಾಳಾಗ್ಬಿಟ್ಟಿದ್ದಾರೆ. ಕಂಪನಿ ಇಶ್ಯೂಡ್ 1 ಈಕ್ವಿಟಿ ಶೇರ್. ಓ ಮಜಾ ಇದೆ ನೋಡಿ. ದಿಸ್ ಇಸ್ ಸಮಥಿಂಗ್ ನ್ಯೂ ಯಾ. We've done something similar in one of our AQs, but it is something nice. Observe, the company issued 1 share as bonus for every 5 equity shares. When? On 1st of October. I'll tell you what is the annoying part. Here they have given no number of shares outstanding as 8 lakh. This is including bonus issue. Why? This is 31st of March 2024. Bonus issue happened on what date? 1st of October 2023. So how many shares were there at the beginning? We should find it. Ashte alla. During their company further issued 2 lakh equity shares of rupees 10 each on 1st of January. So opening we had certain number of shares. On 1st of October we made bonus issue. Then there is fresh issue. Then there is closing number of shares. How much is closing number of shares? 8 lakh. This has to be figured out first. You know why? Using this we'll find basic EPS. After that only to the denominator we add 1 lakh 36 making it dilutive number of shares. And numerator though we will add no interest into 1 minus t dilution. Come on, let's do this. Observe, I am doing weighted average number of shares. 1st of April 2023 opening balance number of shares, I don't know how many are there. After this on 1st of October there is bonus issue. After that on 1st of January there is fresh issue. Then 31st of March 2024 we know the number of shares as 8 lakh. 1st of April how many shares were there? But we know one thing. If we had 5 shares here, you got 1 share here as bonus. That much we know. Why? Bonus ratio is 1 for every 5. And we know this fresh issue. Fresh issue was how many shares? 2 lakh shares. So after adding 2 lakh, it has become 8 lakh. Before adding 2 lakh, how much will it be? 6 lakh. After adding 2 lakh, it is 8 lakh. Before adding it will be 6 lakh. 6 lakh is like 6 shares. 6 ಇಲ್ಲಿ 6 shares. ಇಲ್ಲಿ 5 shares ಇತ್ತು. 1 share bonus ಬಂದಾದ್ಮೇಲೆ ಎಷ್ಟು shares ಆಗುತ್ತೆ? 6 shares, no? Am I right? Shares outstanding after bonus issue is how many shares? 6 shares. 6 shares 6 lakh ಆದರೆ 1 share ಎಷ್ಟು? 6 lakh into 1 by 6. ಇಷ್ಟಕ್ಕೆ ಇಷ್ಟಾದರೆ ಇಷ್ಟಕ್ಕೆ ಎಷ್ಟು? Bonus issue is 1 lakh shares. And opening balance is 5 lakh shares. This is important. Once you crack this, you should find weighted average number of shares. Don't try to find weighted average number of shares before this. So you should read the question with a calm mind to figure this out, which we have right now in the class. But Papa, people who wrote the exam, I don't know if they would have had that calm, pleasant mind. Because first question, first exam, first time in their life they're writing CA Inter exam. Okay, you should always remember to have a calm mind in the exam. Everything is doable with a calm mind. Right here. 1st of April, opening balance. How many shares did we have? 5 lakh shares. Now, what is the period to be taken? Full 12 months. Full 12 months. April till March. How about 1st of October bonus shares of 1 lakh? Bonus shares. 1st of October. Gandhi says, no, doesn't matter. Hey, Gandhi should remember that whenever there is bonus issue, it doesn't matter the date of issue. We'll consider from the beginning. Why? No cash consideration, yeah. You get it? In fact, you will adjust your previous year EPS also. Adjusted EPS. Fine. Let's take full 12 months. How about your 1st of January fresh issue of 2 lakh shares? This you should take from January. January, February, March. How many months? 3 by 12. Bega. 5 lakh into 12 by 12. 5 lakh. 1 lakh into 12 by 12. 1 lakh. 2 lakh into 3 by 12. 50. Together you get 6 lakh 50 as your weighted average number of equity shares. Got this? For basic EPS computation, they have given net profit after tax as 31 lakh 20. 31 lakh 20 is net profit available to equity shareholders. Weighted average number of shares, just now I computed 6 lakh 50. See this? 6 lakh 50. Divide 31 lakh 20 by 6 lakh 50, we get basic EPS of 4.80. This is basic EPS. They have also asked you to do diluted EPS. There are 2 dilutions. 1 ESOP, 2 convertible debentures. First we'll do ESOP computation. Once again, from the beginning. Now, look at this. How many options are there? 80,000. What is the exercise price? 20. What is the fair value? 25. I would write all 3. Fair value 25, exercise price 20, number of options 80,000. How much money will I collect from my employee? Exercise price or fair value? Because he is my employee, I am collecting exercise price. If he was not my employee, if it was some other third party, I would have collected fair value. So I collected 80,000 into 20. How much money did I collect? 16 lakh. For 16 lakh rupees what I've collected, if I had issued the shares at fair value of 25, how many shares was I fairly ನ್ಯಾಯವಾಗಿ ಎಷ್ಟು ಕೊಡಬೇಕಿತ್ತು? 64,000 shares. ಅಂದ್ರೆ for 16 lakh rupees what I've collected, 64,000 shares I should have given. So 64,000 I'm not doing any favor. I'm giving it to my employee because he gave me cash. But did I give only 64? I gave 80. So out of the total shares given to my employee 80,000, 64,000 I've collected cash. Balance 16 I've given free. I've given free, non-cash, because he's given me buckets and buckets of sweat. He's not kept the bucket, he's kept me buckets and buckets of sweat he's given. So I'm giving him 16,000 free shares. Listen to me. These options are not yet become shares. These options will become shares when they're exercised in the later period. As of today, they're still options. So these will be issued in next year. It will be considered in basic EPS next year. But current year may, even though we don't receive any consideration, because we'll still give in next year, so it is called as potential equity shares in the current period. And we'll consider it not in basic EPS, but in dilutive EPS. So I will take this 16,000 shares as my dilutive EPS, my diluted earnings. Denominator I should take 16. But this is not the only source of dilution. We have one more. What is that? Convertible debentures. 30 lakh rupees divided by 100 is 30,000 debentures. Each debenture is convertible into 4 shares. Let me show that. 12% convertible debenture. 1 share will become 4 equity shares. Right now we have 30 lakh rupees from the way of debentures. Each debenture is 100, which is 30,000 debentures. Do 30,000 into 4 by 1, 1,20,000. So can I say 1,20,000 are potential debentures, sorry, potential shares from debentures? 16,000 is potential shares from options. So can I say together in our denominator, along with 6,50,000, 16,000 and 1,20,000, 1,36,000 will increase. Am I right? So for dilutive EPS, denominator is 6,50,000 plus 1,36,000, which is 7,86,000. Am I right? 6,50,000 plus 1,36,000, 7,86,000. If in case those potential shares turn out to become equity shares. If potential shares in cash, meaning basically our debenture holders become equity shareholders, I don't have to pay them interest. I don't have to pay them. So my profit will no longer be 31,20,000. My profit will increase. I should add back the interest which was previously charged as expense. How much was interest which was previously charged as expense? On 30 lakh rupees, 12%. Do 12% of 30 lakh? 3,60,000 is now no longer my expense. Meaning it will become income. I should add back to 31,20,000. The moment you say profit, no, someone will come, hey, profit and then nange tax kodalva. So we should pay tax on that profit. That is not profit. That is reversal of expense. But it is like profit. How much is the tax on that? 30%. So do 30 lakh into 12%. That is interest. You do into 1 minus t. Tax saver antivalva. Like how we do in FM. Interest into 1 minus t, which is 30 lakh into 12% into 1 minus 30%. So 2,52,000 is what it comes. How much is 30% of 30 lakh? 3,60,000. 3,60,000 was previously charged as expense, interest on debentures. Now, if in case I assume that my debenture holders have become equity shareholders, I no longer have to pay that 3,60,000 interest. Because I no longer have to pay 3,60,000, my profit will increase. On that increased profit, 30% I pay tax. 3,60,000 minus 30%, 2,52,000 is the extent to which my profit will increase, making my 31,20,000 profit as 33,72,000 in the case of assumption where my debentures and my options have become shares. Because of options, there is no dilution in income. Now come on, 33,72,000 divided by 7,86,000 diluted EPS. 4.29 is actually dilutive. It is lesser than 4.8. If it was anti-dilutive, meaning if that was more than 4.80, I would have not disclosed in my financial statements because it is dilutive. 4.29 should go into my financial statements as dilutive EPS.
Come on, guys, let's now solve question number 1B from our Jan 2025 examination paper. This question is from the topic of Accounting Standard 90. Not a very different question, very usual question. There have been several instances where they've asked a question like this. So in this question, what they've done is they've asked you to tell whether the lease for which the asset is given, is it operating lease or is it finance lease? You have to decide that, and you are also asked to determine the unearned finance income. Quickly to tell you about lease, let's say I own the asset. I have given the asset to you on lease. That lease on which I have given it to you can be two types: operating lease, finance lease. The way we decide the decision of whether it is operating lease or financing lease is very important, because accounting for operating lease is very different from for finance. Operating lease means I've given it to you on rent, you pay me rent. You are lessee, the one who's taken the asset. I am lessor, the one who's given. I remain the owner. Whenever you pay me lease payment or lease rental, it is expense to you. Whenever I receive it, it is income to me. To me, lease rental is income. To you, lease rental is expense. I am the owner. I will charge depreciation on it. That is operating lease. In finance lease, it looks like lease, but it is not lease. I have not just given you the asset. I have given the risk, reward, and almost effective control of the asset also. Legally, I am the owner, but by substance over form, you will be treated like an owner. In the case of finance lease, lessor doesn't charge depreciation. Lessee charges depreciation. When do we call it a finance lease? Very simple. The lease asset what I give to you, I should transfer substantial risk and reward of the asset. Second point, the period for which I have given it to you on lease covers the substantial useful life of the asset. Period covers the substantial useful life. Money that I collect from you, which I and you have agreed in the agreement, are two things. One is called as lease rental. Second thing, at the end of the lease, I will give you an option to buy the asset at a price lesser than its fair value in a finance. So basically, you will promise to pay me lease rental throughout the lease period. At the end of the lease period, you will pay me residual value. And you have guaranteed that to me by way of an agreement. So this is the minimum lease payment that you have promised to pay to me. Minimum lease payment is the payment promised by lessee to lessor by way of a lease agreement. That will include two things: lease rentals and guaranteed residual value. And other than the assets that you take, if there is some portion of the asset that you don't take at the end of the lease, I can sell it to somebody else, and somebody else might give me some money. That is money that I will receive not from you but from somebody. That is unguaranteed residual value. Unguaranteed residual value has nothing to do with less. There's something to do with lesser only. I will receive, but you will not pay. You guys getting it? So in this question, they want us to tell whether it is operating lease or finance. Like I just mentioned, you will tell whether it is operating lease or finance lease based on these conditions. Number one, lessee will get the ownership of the asset at the end of lease. Second point, lessee has an option to buy the asset at the end of lease period at a price lesser than the fair value. Condition number three, the lease period covers substantial portion of the life of the asset. Condition number four, money that is promised by lessee to lessor by way of the lease agreement is called MLP. Call it minimum lease payment. Minimum money what the lessee should pay to lessor by way of. That minimum money what you should pay me is not paid today. You pay it by deferred installments over the lease period. If today I would have to consider it, I should not take it at its normal value. I have to take it at present value. If you're paying me lease rental of 1 lakh after 1 year, today its value is 90,900 at 10% present value. If you're paying me 1 lakh lease rental after 2 years, today its value is 82,600. After 3 years, 1 lakh is today 75,100. So basically, you need to apply present value factor and then take it. So the present value of the lease payments, what lessee will pay to lessor, together, it should cover substantial portion of the cost. If it covers substantial portion of the cost, then again it is finance. Asset should be of such specialized nature that only lessee can use. And if somebody else has to use the asset, we have to make major modification. If all of these conditions or majority of these conditions are fulfilled, then we call it finance. What is very important to know here, what majority of the students fail to notice is, few people think of some percentages as substantial period. It should cover minimum 75% of the period, 50% of the period, 90%, 85%. Like the bare text of the standard, there is no such percentage given. So it is decided based on professional judgment. 69% if it covers. Is it good enough or not good enough? We can't tell. You have to see several other conditions, other 4 conditions, and then decide. You guys getting it? So it's always professional judgment, not any percentage cap. Remember that. Now let's start with the question from the beginning. To begin, we have J Limited. The name of the company, J Limited, availed an equipment on lease from K Limited. So K Limited is the owner. K Limited is the owner, or we can call as lessor. This company has given the asset on lease to lessee, which is J Limited. And further, the lease is starting on 1st of April 2020. It is for a period of 4 years. Useful life of the asset is 6. So asset is given for 4 years lease. Its useful life is 6. So that percentage when we compute, that percentage when we compute, we are going to do it like this. Lease period is lease term divided by life of the asset. 4 by 6, which is 66.67%. 66.67% of the useful life asset is on lease. Is this sufficient to make decision? No. We will check other conditions and later judge it based on profession. I can't tell if it is more than 70%, it is finance lease. If it is less than 70%, it is operating lease. No, there is no such condition. Then they're telling cost and fair value of the asset is 12 lakh 50. To me, lesser. It is 12 lakh 50. Meaning if I sell it today and if I collect cash from somebody, I'll collect 12 lakh 50,000 rupees. Now if I collect full cash. But from you, I'm collecting in installments, I would end up collecting slightly. I would have to find the present value of MLP here. To find the present value of MLP, they've told that equipment reverts back to lessor on termination of lease, meaning at the end of the lease, lessee will give it back to lessor. This condition is making it look like operating lease, but not sufficient data to conclude the answer. Let's see third condition. Unguaranteed residual value is 1 lakh 20. Unguaranteed residual value is the money what lessor will receive, not from lessee, but from somebody else. Are you getting it? So I'll find MLP, minimum lease payment to be paid by lessee. So that I will add unguaranteed residual value. That is my gross investment, total investment that I made on that asset. To you, you are supposed to pay only MLP. To me, I'm supposed to collect MLP from you and unguaranteed residual value from somebody else. Understood? And have they told the lease payments? They have not told how much, but all that they've told, cursor was not. You're going to receive 4 equal installments. They've told how much per installment. Have they told how much per installment? No. But they've told 4 lease payments have to be paid by lessee. All 4 are equal. First lease payment is equal to second lease payment is equal to third lease payment is equal to fourth lease payment. Let's use the data. IRR is at 8%. They've given rate of interest also, that present value factor also. Come on. Let's get back to this. See, what we have to do is lease rental for first 4 years is same. To this, I will add guaranteed residual value, which is not given in the question. Are you getting it? On that, present value factor also will be 0. 0.735 is 8% for 4 years. If I add lease rental plus guaranteed residual value, I'll get MLP, which I don't know. Am I right? To this MLP, if I add unguaranteed residual value 1 lakh 20, I will get gross investment. Are you getting it? But this money of 1 lakh 20 plus lease rentals, whatever I'm going to receive, is not today. It is in the future dates. So I'll discount it to today. Shall I? This entire amount is same every year. I can apply annuity factor. Am I right? Annuity factor for 8% for 4 years is 3.31. They've given in the question. Alright, 3.31. And I don't know the amount, so I can't find it. On 1 lakh 20, unguaranteed residual value, as a lessor, I would receive it after the lease period. 4th year, 0.735. 1 lakh 20 into 0.735, you would get 88,200. This is gross investment. Present value of gross investment will be here. Basically, present value of gross investment is also called as net investment, is the money that I would receive if asset is sold right now, full cash is collected right now. This is equal to cost or fair value. This question. How much is cost or fair value given in the question? 12 lakh 50. If I give the asset to you right now, lease illa, illa, full cash and carry, how much money will I collect? 12 lakh 50. In that, present value of unguaranteed residual value is 88,200. Deduct 88,200 from 12 lakh 50, you will get 11 lakh 61,800. 11 lakh 61,800 is the money that I am collecting from you at present value. Meaning I will collect more than 11 lakh 61,800. whatever money you pay, present value of it is 11,61,800. As a lessee, you pay me two things: one, lease rental; two, guaranteed residual value. In this case, guaranteed residual value is zero. Can I say entire 11,61,800 is lease rental that you pay present value? That is after present value factor. So there is some amount. If I multiply that with 3.312, I'll get 11,61,800. So take 11,61,800 and divide it by 3.312. What do you get? 3,50,785 rupees is what you pay at the end of every year to me. For how many times? 4 times. So do 3,50,785 into 4. How much does it come to? 14 lakh plus 0 guaranteed residual value. Basically, the money that you are supposed to pay me is 14 lakh 3,140. But you pay it in 4 installments. The present value of it is 11 lakh 61. And I will receive that money from you. I'll also receive 1 lakh 20 from somebody else. So I'll add them together. It is 15 lakh 23,000. Basically, as a lessor, from you I collect 15 lakh 23,140. How much money do I collect? 15 lakh 23,140 over 4 years. If I find the present value, I'm collecting only 12 lakh 50. More than 12 lakh 50, whatever I'm collecting from you is because of delay. If you would have paid full money for the asset right now, I would have collected only 12 lakh 50. I've collected that extra. How much is extra? 15 lakh 23 140 minus 12 lakh 50. That money I've collected only because you have delayed the payment. 2 lakh 73,140. That is more like interest income to me or finance income to me. And at the beginning of the lease, it is not yet earned. That is what is called as unearned finance income. People use formulas to do this. I'm telling you, no need to use formula. Lease rental plus guaranteed residual value, MLP. MLP plus unguaranteed residual value, present value. Sorry, GI. If you find present value of this, and you will get present value of GI, which is N9. Difference between present value of GI and GI is nothing but unearned finance income. Works good for any problem on AS19. You don't have to use even a single formula. Literal logic can solve any problem. Whether it is backward, forward, number missing, number available, anything. Second part of the question, they've asked you to determine unearned finance income here. That is 2,73,140. For checking whether it is finance lease or operating lease, we need to compare present value of MLP. MLP is 14 lakh 3,140. Present value is 11 lakh 61,800. Take 11 lakh 61,800 divided by 12 lakh 50. See here, we'll take present value of MLP 11 lakh 61,800 divided by 12 lakh 50. That covers how much percentage? 92.94%. And lease is not lessee is not getting the ownership, but it is given back. Keeping that aside, 66% of the useful life the asset is with lessee. 92.94% of the money is collected back. Considering this, I will give the answer based on professional judgment. This lease is actually finance lease. So lessee should act like owner. Lessee should record and charge depreciation, not. And this is the answer to this question. Come on guys, let's now solve question number 1C from our Jan 2025 examination paper. This question is from the topic of accounting standard 15, which deals with employee benefits. You have kept a good blend. It is little bit theory, little bit practical. Prima facie, when you look at the question, you feel like a very easy question. Similar question is there in material. But let me clarify, there is no such question in material on this. Study material, there is no this kind of. Conceptually, if you are aware, doable one. There is only very small trick. It's about common. And I understand it would have not been easy processing that in the exam. But if you calmly sit and then see the question, it's quite easy. There are 4 numbers. The answer should be very simple to process. Let's start. What is the difference between defined contribution plan and defined benefit plan? This is very clearly covered in our chart as well as our classroom discussion. A lot of problems answers are actually based upon the accounting standard 15. Here, literally we discussed that defined contribution plan and defined benefit plan difference as the one of the first prime. Let me tell you what is defined contribution plan and defined. At the age of 30, an employee joins your organization as an employee. He is going to work with you for next 30 years. At the age of 60, when this employee retires, we have to give him some retirement benefit. gratuity, health insurance benefit, or some benefit. What you as an organization should do is you should ensure that he gets so much money. Let's say you promised him 50 lakh rupees. 50 lakh rupees will not be booked as an expense in 30 years later, 2055. 30 years now is 2055. In 2055, I'll not book 50 lakhs as expense. From now, I should keep little money aside every year so that it will become 60 lakhs at the end of 2050. When I'm doing this, let's say I'm a very small entity. I have 10 employees. I don't know what to do. What will I do? I will go to LIC. I'll go to PF Institute. I'll go to mutual fund agency. I'll ask them, sir, I have 10 employees. To all 10 employees, after 30 years, I want to give 60 lakh rupees. I want your help. Then that fund management house, PF or LIC will tell, okay, pay me 15,000 rupees every month. Pay me 15,000 rupees every month. Leave it to me. I will take it as a responsibility. 30 years later, I will give you 60 to your employee. I'll give 60 lakhs to your employee. You don't worry. Your responsibility only giving me 15,000 every month. Here, organization's responsibility is limited to giving 15,000 every year to that PF Institute or LIC Institute. The moment I give 15,000 to that, no, my hands are clean. My responsibility is over. Defined contribution plan. My plan is to contribute a defined amount. Once I contribute the defined amount, my hands are free. Paying the employee 50 lakh or 60 lakh rupees at the end of 30 years is LIC's responsibility, not my responsibility. This is defined contribution plan. However, I don't have 10 employees. I have 10,000 employees. I'm a very big entity. For every employee 15,000, 10,000 into 15 per month for 12 months. If I pay to them, no, they will invest in my competitor only. They will buy shares of my competitor. So he is doing better than me using my own money of my employees. Oh my God, this is not fair. And when I'm such big entity, I don't need help of LIC. I don't need help of PF Institute. Now what will I do? I'll hire one fund manager. I'll give all the money to him. I will say, I don't know what will you do, where will you invest? Invest in gold, invest in copper, invest in silver, invest in shares of some company, invest in gold bonds, fixed deposit, I don't care. Make that money become 50 lakhs per employee in 15 years or 20 years. I'll give him a responsibility. Here, my responsibility is not limited to keeping 15,000 aside. My responsibility is extending to the date on which I am supposed to pay 60 lakhs to my employee. Here, my liability is contributing 60 lakhs to my employee after 30 years. This is defined benefit plan, where my liability is to give the benefit of 50 lakhs to my employee when he retires. Simple difference between defined benefit and defined contribution plan. Well, look, just have to write this. Defined contribution plan. Post-employment benefit under which an enterprise pays fixed contribution into a separate fund will have no further obligation. An entity, once you pay that fixed contribution to an entity or to an organization, liability is not there, closed. However, what is defined benefit plan, post-employment benefit plans other than defined contribution? Is the definition as per yes. Whatever is not defined contribution plan is defined benefit. In defined benefit plan, I have liability till the date of retirement as an employee. Under defined contribution plan, my liability is only to the extent of deduction and payment of money to the fund house. The moment I pay, they will take care of paying money to the employees. Understood this? This is the first one. Next one, they're asking under defined benefit plan, meaning I have taken the responsibility to pay a specific amount to my employee. They're telling how much money can I withdraw? How much money can I withdraw? That is the question. Read this. From the following information, calculate. From the following information, calculate the amount of defined benefit liability or asset. Okay, let's do it. Present value of DBU. After 30 years, I'm supposed to pay some money to my employee. That is supposed to be paid after 20 years or after 30 years or after 15 years. That is a liability after 15 years. Today's value, whatever is there, that much money I should keep aside. That money, whatever I found it, after 15 years, if I have 50 lakhs obligation, present value of that 50 lakhs after 15 years today is 36 lakhs. How did I find present value? I would have taken an internal rate of return, IRR. At that rate, I go on earning interest. 50 lakh after 15 years is 36 lakh today. On that 36 lakh, if you apply 15% interest for 14 years or 10 years, that next 15 years, it will become 50 lakhs. That is present value of DBU. I would have to invest 36 lakh. They're telling 36 lakh is present value of defined benefit of and fair value of plan asset. So much money I've kept in my assets. maybe some securities, some risky, some non-risky, small cap, mid cap, fixed deposit, gold, B's, Nifty, EF, ETF, everything together. It's 38.5. 38.5 is the asset that I've made. It's fair value. Today, if I sell all the assets, value is 38 lakh 50. And today's liability value of what I'm supposed to pay in the future, present value of that liability is 36 lakh. And further, they've told past service cost not yet recognized, 7.5. Past service cost means employee has given me services. I have to give him benefit. Benefit is supposed to be booked today as an expense, but it will be paid on retirement. That 60 lakhs what you pay your employee after 30 years of service. That is for 30 years of service. You book it as expense every year of service. You pay it after service. Understood? So in the past, service is given by employee, but we did not write expense. How much? 7.5. Unamortized past service cost 7 lakh 50. Can I say asset including this is 46 lakh? Basically 38 lakh 50 I've already created asset. 7 lakh 50 employee has given me service. I would have to give him money of 7 lakh 50. Not now, later. So I have to make further assets of 7 lakh 50. So my asset should have been 46. Asset should have been very good. Then they're telling present value of available future refund is 6. See, my liability is how much? 36 lakh. Present value of future obligation is how much? 36. How much is the asset? 46. I can actually withdraw how much? 46 minus 36. I can withdraw up to 10 lakhs. I can withdraw up to, but in the question they've told present value of the future available refund is 6. So they're telling maximum I can withdraw 6. So I'll take whichever is less and I'll say I'm restricted to withdraw only 6 lakhs. Withdraw to pay the employee. Today, if the employee quits the organization and leaves, I can withdraw only 6 lakh. That's what they've given in the question. Answer is actually ending at 6 lakh. Based on a conceptual understanding of the student. Looks very simple, but you should know that you should take past service cost to be added to the plan asset already there. Compare that with the present value of DBO that is there. 10 lakh will be the amount available for withdrawal. However, they've told present value of amount withdrawable is only 6 lakh. So it is restricted to 6. That set is what you should. Looks very easy. And the day I'm solving this, the suggested answers of the institute is not yet out. The answer according to me, let's however wait and see what is. Come on guys, let's now solve question number 2 from our January 2025 examination question paper. This question is from the topic of internal reconstruction. One of the very lengthy questions in this question paper. The question all by itself will go for 4 pages. First page they have given balance sheet. Second page notes to accounts. In the second page they start with adjustments. They have given adjustments throughout in the third page, and in the fourth page is where it ends. Let's see at the end of the fourth page what have they asked us to do. They've asked us to pass journal entries necessary to record the above transactions what is discussed, and they also want us to prepare notes to show the revised share capital structure of the company after completion of the scheme. They could have asked complete balance sheet with notes to accounts, but they have not asked. The class when we did the questions, we did complete balance sheet with notes to accounts and disclosures. Here they've asked only one, share capital of the company after the internal reconstruction. Basically 12 adjustments are there. For all the 12 adjustments, we would have to write the journal entry. You can assume that 1 mark for each of it, 2 marks for writing the share capital notes to accounts. Let's start from the beginning. Uncalled capital. I will not waste time reading the balance sheet and notes to accounts. I'll straight away start with journal entries, adjustments. Uncalled capital is to be called up in full, and such shares, other fully paid up equity shares are to be reduced to shares of rupees 5 per share. See the notes to accounts. Is there partly called up shares? Yeah. 8% preferential, 25,000 equity shares of rupees 10 each are called up only to the extent of rupees 8. 2 rupees uncalled will be called now. So to the extent of 2 for 25,000 shares, first make the call. When you make the call, the journal entries share call account debit to share capital account. Let me write it like this. Equity share call account debit to equity share capital account being share call made. This is for 25,000 shares, and for each share rupees 2 is called. 25,000 into 2, 50, 50. Share call made. Money is rightly received. And the money is received entry will be bank account debit for money received, and share call what is debited here will be credited 50,000 50. Share call done. These are shares of rupees 10. The question says we should reduce these shares to shares of rupees 5. So 10 rupees share will be reduced to 5. That 5 reduction will go to capital reduction account. I will take their shares of rupees 10, transfer 5 to capital reduction, give them shares of rupees 5. Number of shares issued will be same. How many shares are we going to take? Not just 25,000, but it is 25 plus 50, 75,000. Now 75,000 shares of rupees 10 will be taken. I'll debit equity share capital account shares of 10. 75,000 shares into 10, 7 lakh 50. Give them shares of rupees 5. I'll write 75,000 shares into 5. That is 3 lakh 75,000. And difference of rupees 5 per share will be transferred to capital reduction account. I will credit capital reduction account to the extent of 3 lakh 70. This is adjustment number 1. 3 entries done. Next, let's go to adjustment number 2. Adjustment number 2 says that preference shareholders will accept a reduction of rupees 2.5 per share. Their shares are of rupees 100 or 10. Let's see. It will be reduced by 2.5. That 2.5 what is reduced will go to capital reduction. In exchange, the rate of dividend is to be increased to 9. Oh, we are basically snatching away their old shares, giving them new shares. They have 8% shares of rupees 10 each. We will take those shares from them. We will give them 9% shares, but they will not be 10. It will be 7.5. 2.5 what they will give up will go to our capital reduction. The journal entry will be, you will debit 8% preference share capital account debit shares of 10, which is 30,000 into 10, which will be 3 lakh. 30,000 into 10, 3 lakh. Credit will be 9% preference shares of 7.5. Number of shares is same, 30,000 into 7.5, which comes to 2 lakh 25,000. Balance 75,000. That is 30,000 shares into 2.5 per share. What is reduction? Will be transferred to capital reduction account. This is adjustment number 2. And we have successfully completed this adjustment number. Can we go to the third one? Let's see the third adjustment. See, first page is useless for us. We never went there. Second page, notes to accounts, we're reading only when we need. So we're actually starting, we're already in third page now. Question runs to 4 pages, 3.5. We're in third page. So don't freak out when you see a lengthy question. 2 reasons. The paper size is slightly smaller, font size is slightly bigger, gap between 2 lines is also more. This question, if we put it in our material, we'll put this complete question in less than a page, 3/4 of a page max. Why? We save paper. Exam, the point is not saving paper, clear understanding of the. And again, ICI, since objective is not to make you people freak out looking at the length of the question. No, that's not the case. Preference shareholders will forgo their claim of dividend for 1 year. The moment they say this, we have to firstly check whether preference dividend, what is not paid, is it liability in the balance sheet or is it a liability outside balance sheet? If it is a liability in the balance sheet and it is forgone, there will be journal entry. If it is an unrecorded liability which is forgone, there will be no journal entry. Okay, so have a look. Come back to the question to see, is there liability anywhere? Long-term borrowing? No. Any other current liability? No. So they have given here preference dividend has been in arrears for 3 years. This is not a liability in the balance sheet. If this liability is, so to say, written off, there is no journal entry. There is a liability in the balance sheet and you write off. You will write liability to capital reduction. A liability which is not there in the balance sheet should be first created as a liability, for which you will write capital reduction to liability. When you write off, liability to capital reduction, no point. Understood? But outstanding for how many years? Okay, they are settling. Some adjustment is there. Remember that. How much is it? Settling for 1 year. We'll forgo 1 year's dividend. And 1 equity share of rupees 5 each is to be issued for the remaining arrears of dividend. 3 years, 1 year they forgo. For 2 years, amount might be more, but we're giving them equity shares of rupees 5 each. So 2 years dividend amount divided by 5. Are you getting it? Come on, let's do this computation. I'll do one proper working note. How much is the number of debentures, number of preference shares that is there? 3 lakh debentures. 3 lakh debentures. What is the, 3 lakh preference shares. 3 lakh preference shares. What is the dividend rate? 8%. So, 30,000 preference shares of rupees 10 each, basically 3 lakh rupees. So, you can do 30,000 into 10 into 8% or 3 lakh into 8% for 3 years. That's what is outstanding. Do 3 lakh into 8% into 3 years or 30,000 into 10 into 8% into 3 years. 72,000 is the total arrears of preference dividend. Forgone 1 year. Yeah, forgone 1 year. 1 year is how much? 3 lakh into 8% into 1 year. How much is that? 24,000 is written off. There will be no journal entry for this. Why? Unrecorded liability written off, no journal entry. For 2 years, how much will be the amount? This will be settled by issue of equity shares. 3 lakh into 8% into 2 years comes to 48,000. This is settled by issue of equity shares of rupees 5. How many equity shares to issue? Divide 48,000 by 5. 9,600 equity shares of rupees 5 is issued to settle 48,000 rupees of liability. Remember, this 48,000 liability is not a liability in balance sheet. So whatever is given, it is not given against liability. There is no liability for you to debit. You have to write capital reduction account debit to equity share capital account. Shall I write that? And shares are issued of nominal value 5. When they've asked us to prepare that notes to accounts for share capital at the end, this equity shares also should be considered. There were 75,000 shares of rupees 10 reduced to shares of 5 plus this. I would write here capital reduction account debit to equity share capital. How many? 48,000 rupees is the value. 48,000 divided by 5 if you do, you'll get how many shares? 17? 9,600 shares into rupees 5 per share. We've written in the working note. I'll write it once again just to ensure that you don't mess up and then you don't find it like where is it written. I've written it at both places. And at the end I'll share the PDF of this. Don't worry if you'd want to refer this once again. Come on, let's go to fourth one. Shall we? Very good. So you will not pay any attention to balance sheet or notes to accounts. Go on reading adjustments in the order and you will be able to solve the entry. Mr. X holds 10% of debentures rupees 2,50,000. He is also a creditor for rupees 50,000. So in the internal reconstruction process, if we are settling Mr. X liability, close Mr. X completely. Meaning take his debentures, take his creditors, debit them, credit Mr. X account first, and then do settlement to Mr. X. He agreed to cancel 50% of his total debt. 50% will be transferred to capital reduction. 2,50,000 plus 50, 3 lakh. In 3 lakh, 50% transfer to capital reduction. Balance is 1,50,000. 1,50,000 transfer to capital reduction. 1,50,000 is still there. So they're telling including interest. Proportionate interest we should find. We don't know how many years interest is pending. 10% debentures is there, no. If it is 1 year, 25. If it is 2 years, 50. 3 years, 75. We don't know. I don't think they've given direct information. We have to figure that out once again. Shall we see how much of interest is outstanding? Can there be more than 1 year interest outstanding? Yeah, there can be. Observe here. They've told interest outstanding, interest outstanding, interest outstanding anywhere. Reserves and surplus, long-term borrowing. Maybe they've not given notes to accounts, but they would have given in balance sheet straight. When there is not too much detail required, certain items they'll give straight, no. See, other current liability is given straight in the balance sheet. How much? 45,000. 1 year. How do I tell? Very simple. Debentures is 4,50,000. Interest rate is 10%. 4,50,000 into 10%, 45,000. How much of this 45,000 belongs to Mr. X? 25. Why? Out of 4,50,000 worth of debentures, Mr. X sold 2,50,000 worth. 4,50,000, 2,50,000. So 45,000, 25,000. If you want to do cross multiplication to find, or 1 year is the easier computation part. Shall I write? Okay. How much money belongs to Mr. X? 2,50,000 worth of debentures, 50,000 worth of creditors, and 25,000 worth of interest. I will debit all of them by closing that liability and credit it to Mr. X. Let me write The 10% debenture account debit 2,50,000, creditors account debit 50, and interest payable 25. Everyone understood 25? Very good. To Mr. X account to 3,25,000. And I'm going to settle Mr. X 3,25,000 now. How? 50% he gave up. I will credit 50% to capital reduction account. I would write here capital reduction 3,25,000 into 50%, 1,62,500. How am I going to settle the balance 1,62,500? Read the question. Pay 20,000 rupees to company. To company. He is giving 20,000. We are receiving it. So I will debit our bank account by 20,000. We were supposed to give him 3,25,000. Debenture, creditors, interest together. 1,62,500 he gave up. So we should pay him balance 1,62,500. In return, he gave 20,000 cash. So now we have to give him something worth 1,62,500 plus 20,000, which is 1,82,500. Understood? Read that later part. To receive new 12% debentures for the balance. Whatever is the balance here, we're going to give him 12% debentures. 1,82,500. This is adjustment number 4. Everyone got this? Easy? Let's see adjustment number 5. Remaining claim of the debenture holders. 4,50,000 worth of debentures were there. Mr. X owns 2,50,000. Gone. Remaining is 2 lakh. And including outstanding interest. Outstanding interest was 45,000. In that, what belongs to Mr. X is 25. You remove 25, remaining is 20. So 2 lakh worth of debentures, 20,000 worth of interest. Together 2,20,000. Both are liabilities in the balance sheet. We are once for all closing it completely. I would write it. It is reduced to 60%. Meaning 40% is transferred to capital reduction. Accelerate that 40% to capital reduction first. Observe, this is slightly tricky. This adjustment is tricky. The key in solving questions in internal reconstruction is catching English, which I myself also am not that great at. What I do? Very simple. Break it into smaller parts. Read little, understand. Before you forget, process and write it. Then you read the remaining part. Understood? Don't try to eat everything at once. It will become little bit difficult for your body to process. Let me write here 10% debentures, balance of 2 lakh, 450 minus 2,50,000, and I'll write interest payable 45 minus 25, 20. And amount is transferred to debenture holders. Sir, interest also should be paid to debenture holders. And entries also, don't try to write combined journal entry. Let's wait and see for the suggested answers of the institute to come. The day I'm recording this is way ahead of the suggested answer date. Okay, so when you see the suggested answer, I doubt there will be the split entries. Lot of places there will be combined entries, one single entry. You get it? So we are not God level. We are at the the devotee level. At the devotee level, break it into smaller parts. Okay. Debenture holders 2,20,000. You get it? Now, how much is to be transferred to capital reduction? It is reduced to 260. Reduced to 260 means reduced by 40. Please do 2,20,000 into 40%. Or 2,20,000 minus 60%. 88,000 is transferred to capital reduction. Balance is how much? 1,32,000 we owe them here. This is where the beauty comes. Observe this. This I would need your full attention and focus. In consideration to the reduction, the debenture holders are to receive new 9% preference shares at new face value. Here there is an element of gray. Are these 9% new preference shares given for that 60% what they gave up, or is this for, is it for that 40% what they gave up, or is it for the balance 60%? It is for the balance amount is my interpretation based on the understanding of all the questions that I have done. I have one more stronger reason why this is right. Let's say for the 40% reduction only you are giving this. Then problem number 1, remaining 60% should be shown in the balance sheet. What will you show it as? Debentures or outstanding interest? How can you leave outstanding interest in your balance sheet and still do internal reconstruction? Incorrect. And would you still show them as debenture holders? Not fair. You're doing this. It's settled. One reason. Here they have not asked balance sheet. So you will not get that doubt. So you might make the wrong assumption. But I'm trying to tell you, you have to think about balance sheet also when you do internal reconstruction. Just because it's not asked in this question doesn't mean that you are careless about it. Are you getting it? Second assumption, second reason, very strong reason. This is a very valid reason. Okay, consider this. How much is the money that is supposed to be paid? 2,20,000. In that they've given up 88,000. You agree with me? Yeah. If for that 88 you are giving, that 88,000 if you divide by this new preference shares are at 7.5. If you divide, you will get decimal number of shares. You will get fractional shares. You will get fractional shares. By 88,000 divided by 7.5, it's not divisible. Are you getting it? However, if I go with the balance amount, 220 minus 88, balance amount, I'll get whole number. So that is one strong reason why I'm assuming that it is reduced by 40, reduced to 60, and for the balance amount, we are settling it by preference shares. And after this journal entry for adjustment number 5, if in case I prepare balance sheet for this company, the balance sheet there will be no traces of debenture holders, debentures or outstanding interest. Let me, no, 9% debentures, nominal value 7.5 to determine number of shares to be issued. Let me show that to you with the help of computation here. Let's see, 2,20,000 minus 88,000. How much do we get? 1,32,000. Divide it by 7.5 per share. Shares were originally of 10. We reduce it by 2.5 to 7.5. So please do 1,32,000 by 7.5. You'll get 17,600 shares. If you do 88,000 by 7.5, you will not get. So did you understand the basis for my assumption? However, let's wait and see what is the answer that institute will give. If you do 88,000 divided by 7.5, then you would have to write that fractional amount by cash or anything again, leading to more than one assumption. You can't issue fractional shares. Shares are already shares. How can you share the share? Agala. Did you understand this? Very good. And this will also come up in our notes to accounts. They've asked notes to accounts for share capital. Fifth adjustment done. This was the most tricky adjustment in the question paper according to me. Let's see. Question number 6. Taxation liability is to be settled at 1,20,000. Come to balance sheet. How much is taxation liability? It's not there in notes to accounts. See the balance sheet only. Provision for tax is 1 lakh. 1 lakh rupees liability is now settled at 1,20,000. 1,20,000. You would have to pay 20,000 extra. That will be further going to capital reduction only. So I would write provision for tax account debit 1 lakh, but I will credit my bank account by 1,20,000. That additional 20 will be capital reduction account. Did everyone get this? Fantastic. Provision for tax account debit, capital reduction account debit to bank account. What do we have after this 6th one? Let's go to the 7th one. Market value of non-current investments is 2,50,000. Why are they telling this? Investments to be brought to their market value. We need to revalue the investments and record them at 2,50,000. Observe the investments in balance sheet. Investments in balance sheet is 2,80,000. We should record them at 2,50,000. If 2,80,000 worth of investments are to be recorded at 2,50,000, we'll reduce its value by 30. So don't write 2,80,000 anywhere. Reduce it by crediting non-trade investments by 30,000 and debiting your capital reduction account by 30. This is 2,80,000 minus 2,50,000. I hope everyone understood this. I will now proceed to adjustment number 8. Adjustment number 8. Inventory equal to rupees 1 lakh at book value will be taken over by remaining creditors in full settlement of their claim. Very useful. They've given the word remaining. If they would have not given the word remaining, lot of them would have done mistake. Why? Out of the creditors, to an extent creditors, 50,000 is Mr. X. Balance creditors only should be settled. How much is creditors in the balance sheet? Have a look. Creditors or trade payables in the balance sheet is 1,30,000. In 1,30,000, 50,000 Mr. X gone. Balance 80,000 is settled by issue of inventory costing rupees 1 lakh. 80,000 settle madake, we have given 1 lakh. 20,000 namige loss. But I have to write that. Shall I write here? I would write creditors account debit. Instead you can write trade payables debit. How much is it reducing by? 80. Remember 1,30,000 minus 50. And I'm giving them my inventory worth rupees 1 lakh. Difference of 20 will be capital reduction account. Did everyone get it? Very nice. Then ninth one. Bad debts provision of 2% is to be created on trade receivables. Let's see how much is our trade receivables. On that 2% will be created not by debiting P&L, which is usually done. In this case, we'll debit. Very good. Come on here. How much is our trade receivables? Is 2,30,000. On 2,30,000, compute 2%. I will credit our trade receivables. I can actually credit provision for doubtful debts also. I will debit capital reduction. It will be 4,600. Instead of trade receivables, I can write capital reduction account debit to provision. In fact, that will be wiser. And our balance sheet, when I prepare, I will deduct that provision from my trade receivables. Provision doubtful debts account. How did I get this 4,600? It is debtors of 2,30,000 multiplied by 2%. After that, let's see 10th one. What do we have in 10th one? 10th one, plant and machinery is to be written down by 20%. Identify the value multiplied by 20%. Come to the question. Plant and machinery 7,50,000. They have they told property, plant and equipment or plant and machinery? Only 7,50,000. If they would have told PP, they would have taken 8,50,000. Come on, let's do depreciation but not debit depreciation. Any profit or loss arising in the process of internal reconstruction will be debited to, very good, capital reduction to PP. How much is that? 7,50,000 multiplied by 20%, 1,50,000. Did everyone get this? After this 10th one, let's go to 11th one. In 11th one, what is the 11th adjustment? Company will further issue 12% debentures for such amount is sufficient to pay off bank overdraft. They have bank overdraft. You should issue certain number of debentures. How much they have not told. We should find it. And other outstanding liabilities, and to maintain cash and bank balance of 85. You have to pay two things. One, bank overdraft. Next one, other outstanding liabilities. Both should be paid and you should still have 85,000. So basically, I'll prepare one bank account. That's a simpler thing to do. I'm going to pay. So I'll write on the credit side. How much balance should be there? Balance carried on will be 85,000. That is the balance I want after paying my other current liabilities. How much is other current liabilities in the question? Let's see. Is there any other current liabilities in the question? Other current liabilities, 45,000. That adjustment we've already done journal entry. Already written in journal entry. In all the journal entries, wherever there is bank balance, I will write it. Debit, credit, everything. And I should basically find it. Come on, let's start with the balance sheet number. I have bank overdraft of 65,000. This is not a positive balance, negative balance. I would write by balance brought down 65. 65,000 is my opening balance. And I should have 85,000 closing balance. After paying any other payments that I should make, after considering all the receipts. Let's see how much is the shortage. Shall we? Let's start with journal entries. Identify in each journal entry, do you have bank account anywhere? I have here bank account debit 50. That means I have received 50,000. I have received 50,000 to equity share call. In my bank account, I would write to equity share call. How much? 50,000. Then I'll go back to the entries. Let's see the second again. First entry over. Here no cash. Here no cash and bank. Here no cash and bank. Here we have bank 20. We have further received how much? 20,000. This is for that issue of 12% debentures. So I'll write in bank account to 12% debentures 20,000. I would write here to 12% debentures. Mr. X gave 20,000 and he took additional debentures. That item. Then after this fourth entry, fifth entry, do you have anywhere bank? No. Sixth entry, provision for tax paid 1,20,000. In bank account, I'll write by provision for tax and by capital reduction. I can straight away write by provision for tax 1,40,000. How much did I pay? 1,40,000. Oh, sorry, 1,20,000. 1 lakh was the provision, but I paid 1,20,000. Understood? Then, is there any other payment after sixth adjustment? Seventh one, no. Eighth one, no. Ninth one, nothing. 10th one, nothing. That's it. So now understand this and identify how much is the money that I want. I should I had minus 65,000 in my bank. I paid 1,20,000 and I have closing balance of 85. But I've received only 70,000 rupees in any other way. 2 lakh rupees worth of 12% debentures are issued by company. They've told you should issue sufficient number of debentures so as to maintain balance of 85,000 after paying bank overdraft and other current liabilities if there is any. That is provision for tax what I paid. Can I write 2 lakh rupees? Journal entry is bank to 12% debentures. Don't stop at that ledger. You have to write journal entry. Marks are allocated for journal entry, not for ledger. Ledger is only working note. Got it? Let's see the last entry. What have they asked us to do at the end? Adjustment number 11 over 12. Amount available by scheme, basically in capital reduction, will be utilized in writing of goodwill, debit balance in P&L. This anyways we will do even if they don't tell. They've told after this if there is any excess, we'll usually transfer to capital reserve. They're telling before you transfer to capital reserve, adjust against inventory. After adjusting inventory and writing off inventory, if you still have excess, then you should transfer to capital. Did everyone get this? Come on, let me write this. To do this, I would have to identify the balance in capital reduction account. I can prepare a ledger or you can help me with the calculator. Will you help me with the calculator for me to save time? Please take your calculator, everyone. First entry, no capital reduction. Second entry, no capital reduction. Third entry, we have credit 3,75,000. Take minus 3,75,000 in your calculator. Done. And in the next entry, we have again minus 75,000. And here I have debit 48,000, meaning plus 48,000. Minus for credit, plus for debit. Whoever has not done, I'll tell once again. Start with minus 375. Again do minus 75. Now do plus 48. And now continue. This entry there is no capital reduction. Here again credit. You do minus 1,62,500. Understood? Again here nothing. Here you do again minus 88,000. And here you do plus 20,000. Then next entry plus 30,000. And debit again plus 20,000. Plus 4,600 plus 1,50,000. What do you have in your calculator? Is it minus or plus? Minus. To close it, I would have to do plus. Basically, debit it. 4,27,000. If in case you choose to prepare ledger, this is how it would look. Okay, I'll finish the entries and then come. And using this, what do? We'll first write off goodwill, then P&L debit balance. Then we would have transferred to capital reserve, but they've told inventory. How much is goodwill in balance sheet? Goodwill in balance sheet is given in intangible assets. It is to the extent of 60,000. I would write here credit 60. Then I will also credit P&L account debit balance. P&L account debit balance is 2,50,000. I will write 2,50,000. 2,60,000. No, I still have balance left. I would write it to inventory. Don't write full amount to inventory. Inventory will become negative in the balance sheet, which they have not asked. But still, if you prepare, you have to always have that vision. Yeah. Come on, have a look at inventory. Inventory is 1,20,000. Here, do we have more than 1,20,000? Yeah, we have more than 1,20,000. 250 plus 60 is 3,10,000. 3,10,000 minus 4. Oh, we don't have so much. Okay, then we'll write off. How much? 1,70,900 is available. How much is inventory? 1,20,000. So how much will I write off? 1 lakh. But you need to remember 1 lakh worth of inventory is taken over by creditors. Only 20,000 worth of inventory is remaining. Trade payables took over inventory worth 1 lakh. So only 20,000 is remaining. Oh my God. At this step also you would have drift. So after deducting 20, whatever is left will be transferred to capital reserve. And if you prepare capital reduction account, it would look somewhat like this. I've done the same thing. You would have to do one small notes to accounts for share capital. In that you would write 75,000 equity shares of rupees 7.5 each. And then you will write that preference shares. Some preference shares of 8% are now changed to 9% at 7.5. And some preference shares are issued somewhere here. Here. So you had originally 30,000. Now you have 17,600. 47,600 preference shares of rupees 7.5 each and 75,000 equity shares of rupees 7.5 each. That calls for the end of this 14 marker. Let's now start with question number 3A from our Jan 2025 examination paper. This question 3A is on the topic of Accounting Standard 29, provisions, contingent liabilities and contingent assets. Let's start reading a 7 marker question. An engineering goods company provides after sales warranty. So the role and responsibility of the company doesn't end when they sell goods. After they sell goods, they will promise, sir, for next 2 years, if there is any problem in the product, you get it to me. Full service free. That service free, no, that is warranty. If the asset stops functioning, it will be repaired free of cost. But to customer, it is free. For the company, they still have to incur expense. That expense, what you incur for repairing the product, but you don't charge the customer, will become your expense. You don't recover that. That expense should not be recorded on the day when you incur. You expect or anticipate it right now and then record it based on conservatism. And how many of the customers will come back? Let's say you're selling goods to 100 customers, 100 units. How many units will come back to you during the warranty period for repair? We don't know. You estimate something, that is an accounting estimate based on which we create provision. Provision is made based on the estimate of number of customers who will come back to you for the service during the warranty period. On this, we'll make provision applying the concept of conservatism. Read this. For 2 years, how long are we giving free service? Or we will not call it free service. We say warranty period. How much? 2 years to its customers. Based on the past experience, like I mentioned, accounting estimate is what is made on past experience based on present situation. Considering past experience and present situation, we make accounting estimate. The company has been following the policy for making provision for warranties on the invoice amount of the product. We are expecting that whenever a product comes back to repair, the money that we will incur is a specific percentage of the invoice value. Within the first 1 year, it will be 2.5%. Like if the invoice is more than 1 year, 4.5%. The asset is just sold. They come back after 1 month, 2 months, 3 months, up to 1 year. We'll incur very less amount for repair because brand new asset. We might incur up to 2.5%. If it is more than 1 year, we'll incur 4.5%. Did you understand that? And provision is to be made only for first 2 years. 2 years, 1 month is the time from the date of sale. Customer, if he comes back, it is not covered under the warranty period. You charge him money. So when you are charging money, that's not your expense. It will be recovered. So you don't have to create provision. They've given dates and they've given the invoice values. 20th February, 17th July, 27th January, till now, till this 27th January and 1st of March, it is, no. 20th February, 17th July, 27th January is year 21-22. 1st of March is year 22-23. 24th of August and 20th of March is year 23-24. There are 3 different years data. Be slightly cautious. What do they want us to do? Calculate the provision to be made for warranty under AS9 as at 31st of March 23 and as at 31st of March 2024. So first I'll do it for 2023. And they're also asking us how much money to be debited to P&L account for 31st March 24. Second year. First year we'll find. Second year, how much additionally should be charged? Because existing provision will be there. You only make additional provision. Slightly tricky, but with presence of mind, easily crackable. Let's start. First, we're doing it for which year? Remember, 23, 31st of March 2023. 31st of March 23 is still here. You will not make provision on 34,000 and 75,000 on 31st of March 23. Why? As of 31st March 23, you have not sold those 2 invoices only. How can you make provision for the future sales? No. Let me write here. As of 31st March 2023, there are 1, 2, 3, 4 invoices. 20th of February 2021, 2 years will be 20th of February 22, 20th of February 23. Am I right? So the 20th of February 2023, that 42,000, 2 years is lapsed. So we don't have to create any provision. However, we need to still do it on that 17th July invoice, 27th January invoice and 1st of March invoice. Are you guys getting it? So I would write 17th July invoice, 27th January invoice and 1st of March invoice. If you would really want, I can write that one more just to make you people understand the concept that it need not be considered for computing provision. I'll tell you why. Right here, 20th February 2021. Amount for that first invoice, can I say, is 42,000. Next invoice is 2547. 2547, 1 lakh. For this amount, no, you don't have to make invoice. You don't have to make any provision. The reason is this is greater than 2 years. What is the age of the invoice? 2021. When am I creating provision? 31st of March 2023. That 20th of February 21 to 20th of February 22, 1 year. To 20th of February 23, 2 years. 2 years plus 1 month plus 10 days. So more than 2 years. No provision needed. Do you need any provision? Do you need any provision? Zero. However, here 17th of July 2021. 17th of July 2022, it becomes 2 years. 17th of July 2023, I can't go, it's 31st of March. So can I say it is less than 2 years, but more than 1 year? It is more than 1 year, less than 2 years. So we would have to create 4.5% provision. However, if it was less than 1 year, I would have created 2.5% provision. Come to this 27 January invoice. From 27 January 2022 to 27 January 2023, 1 year. It is more than 1 year. It will become 3 years by 27 January 2024. So it is more than 1, less than 2. I'll write here more than 1. For more than 1 year, how much provision? 4.5. If it was less than 1, I would have charged 2.5%. Then 1st of March 2023, just recently, 30 days ago. So it is less than 1 year. Provision will be 2.5%. 25,000 into 4.5 is 1125. 47,000 into 4.5 is 2115. 1,10,000 into 2.5 is 2,750. Take the total 5,990 is the provision to be created as on 31st of March 2023, and 5,990 will be charged to expense in 2022-23 financial. Now let's go to 24. They've asked us how much will be the provision as of 31st of March 2024. Now lot of invoices will become outdated. This 20th February invoice is there, no? That is already outdated, not required. This 17th of July invoice is there, no? That will also become outdated. Why? 17th July 2021 to 17th July 2022, 1 year. 17th July 2023, 2 years. We are doing it as on 31st of March 2024. If you would still want, I don't mind writing these two invoices here, but my provision will be 0. Observe this. Here it is more than 2 years. Here also more than 2 years. Provision 0, provision 0. I hope you people got this. Come on, let's go to the next part. However, I'll write the remaining invoices. Remaining invoices as per question is how much? We have 27th of January, 47,000. 1st of March, 1,10,000. 2 more invoices, 24th August and 20th March, and not considered in 23-24. Sorry, 22-23. Why? After 31st March 2023, this were issued. So I'll write 24th August and 20th March, 34,000 and 75,000. 24th August and 20th March, 34,000 and 75. Let's see this 27th of January invoice from 2022 27 January to 27th of January 2023, 1 year. Am I right? To 27th of January 2024, 2 years. Go with greater than 2 years, 0%. Are you getting it? Very nice. Then 1st of March 2023, 1 year will be 1st of March 2024. 1 year over. 1 year plus 1 month. So more than 1, less than 2. Can I write here more than 1 year? For invoice which is more than 1, less than 2, will compute provision at 4.5%. And over here it is 24th of August. August say November, December, January, February, March, April. Like March only. About 5-6 months old. More than 1 year? No, less than 1 year. And this 20th March is 10 days ago. So for these two, I'll compute 2.5%. Just multiply 1,10,000 into 4.5, 4,950. 34,000 into 2.5, 850. 75,000 into 2.5, 1,875. If you add them up, it comes to 7,675. In 2022-23, we've created provision of 5,990. As of 31st of March 2023, provision is 5,990. As of 31st of March 2024, provision should become 7,675. Provision created is not 7,675. Provision to be maintained is 7,675. Already we have existing provision of 5,990. It should be maintained at 7,675. Additional provision to be created is how much? Provision to be made in 31st March 2023, 5,990. Provision to be maintained on 31st March 2024, 7,675. Provision to be additionally created during 2023-24 is 1,685. And this is for 7 marks in this examination. Come on guys, let's now solve question 3B from our Jan 2025 examination paper. This question 3B in this examination is from cash flow statement. And let's get started. Given below are the extracts of balance sheet of BGH Limited. There are two balances, opening and closing. They've first given closing balance, then they've given opening balance. 31st of March 2024 first, which is closing, and then we have 31st of March 2023. Scroll down and come to the end of the question. They've given that you are required to prepare for the year ended 31st March 2024 cash flow from operating activities as well as cash flow from finance. I don't know what is your problem with investing activities, but they don't want you to do investing activities because the investment is not in this, but it's in you people. Wow. Share capital. There is difference between opening and closing balance. Opening balance of share capital is 4 lakh. Closing balance of share capital is 5 lakh. Unless otherwise mentioned, the only reason why this could have happened is there is further issue of shares of 1 lakh. But I can't write straight away in cash flow statement. That might be issue of shares for non-cash consideration also. Do you agree with me? Just see through the question if there is any adjustments. There is no other adjustment. So is there a possibility that this is because of bonus issue? No. So I will skip preparation of ledger account and straight away write that 1 lakh increase is issue of equity shares, which is financing inflow. In my financing activities, I would write issue of equity shares, 5 lakh minus 4 lakh, 1 lakh inflow. That's the reason it is a positive amount. If it was negative amount, that would be buyback of equity. That come back to the next one. After writing this first one, we have P&L account. P&L account opening balance is 60,000 and the closing balance is 1,10,000. So again, there is increase in P&L account balance. So I would have to know what is the reason for such increase. I would write here opening balance 60 on the credit side, closing balance 1,10,000 on the debit side. What do we have after this? Next item. I'll see to it till the end, and that will be the last ledger to close. The reason being, in P&L reserve account, I would find net profit, which will be the opening balance or starting balance for our cash flow under operating activities. Because cash flow from operating activities, net profit is the starting point. Net profit in P&L reserve account is the ending point. This would be the last ledger to be closed. Next, we have 10% debentures issued at the end of the year. They have told it very clearly. Opening is 0, closing is 1 lakh. The reason why they have told that it is issued at the end is not to tell us that it is inflow. That anyways we can figure out. That is to help us determine the interest. Interest should be computed on the opening balance because opening balance is the balance throughout the year and these debentures have come at the end of the year. Because 1 lakh rupees worth of debentures are issued only at the end and throughout the year debentures are 0, interest to be paid during there is 0. So nothing have to be added back in operating activities and nothing has to be written as interest on debentures in financing. Hope everyone got that. Let me write this 10% debentures 1 lakh rupees issued in my financing activity as an inflow. I can open the ledger, but it doesn't make any sense. There is no adjustments. 1 lakh. Did you understand why am I not adding back interest on debentures? Because it is 0. If there was interest, this under this indirect method to net profit, I would have added back interest on debentures and I would have written in financing activity as outflow. Next item. I have with me bank loan of 2 lakh 50 rupees at the end of the year, 2 lakh at the beginning of the year. That basically means I borrowed 50,000 further during the year. There is no other adjustment, but if you really want, we can open ledger. Otherwise, I can write here straight away loan borrowed from bank. It was 2 lakh at the beginning, 2 lakh 50 at the end. Further increase of 50,000 is loan borrowed during the year, which is financing inflow. Next item that I have is trade payables. Because we are doing under indirect method, I can straight away take this in changes in working capital. Trade payable being current liability, I will do closing minus opening. If this was direct method, I would have opened trade payables ledger, writing this opening, closing balance and purchases. My objective would be to find amount paid to creditors, which will appear in my operating activities as cash outflow. Now ledger is not required. I would write 60 and 55. Let me do trade payables, closing minus opening, 60 minus 75 minus 15. After this, we have dividend payable. Please remember not to treat dividend payable in current liabilities and open ledger account. I told you to do the same thing for provision for tax also. Understood that? Let me open dividend payable ledger. It's a liability. Opening balance credit side 50, closing balance debit side 0. That means opening balance of 50 is paid. However, let's not make a harsh call right now. Said it later. Then interest payable on bank loan. Opening 20, closing 20. There is no need to open ledger. If you do want, we can open ledger. Otherwise, we can adjust it directly. Let's open a ledger. I'll write here opening 20, closing 25. There would be loan in the current year also. Interest on the current year also. On the bank loan of 2 lakh and 2 lakh 50, on what amount should I be computing interest? Should I be computing interest on 2 lakh or should I be computing interest on 2 lakh 50? Don't know. We'll discuss that later. We'll just keep it till the end of the problem. Then I have with me goodwill. Goodwill opening is 1 lakh 50, closing is 1 lakh 20. 1 lakh 50 has become 1 lakh 20. I have basically amortized goodwill worth 30,000. Amortized goodwill worth 30,000. That would be non-cash expense debited to P&L. When I write that amount in P&L, my net profit for the year would have decreased. Because it is non-cash expense debited to P&L, I'll add it back. Because previously it is decreased my net profit. Now I add it back to find my cash flow from operating activity, starting with net profit as the basis. So I would write here, our goodwill amortized 30,000 rupees. Understood that? Then we have trade receivables. Trade receivables, I will take it as changes in working capital. Because trade receivables is current asset, I will do opening minus closing. Opening is 95, closing is 65. When we do 95 minus 65, what do we get? 30,000 as changes in working capital from trade receivables. Lastly, there is inventory. Inventory is again current asset. I would have to do opening minus closing, which is 30 minus 55. Let me do 30,000 minus 55,000. I would write inventory 30,000 minus 55,000. What do we get? Minus 25,000. Did everyone get this? Then going further, we just have to find out our operating cash flows and financing cash flows. We have to make a call with regard to bank loan. 2 lakh to 2 lakh 50,000 borrowing. Is it at the beginning or is it at the end? If you assume that 50,000 further borrowing is at the beginning of the year, then you will compute interest on the closing balance of 2 lakh 50. If you will assume that borrowing is at the end of the year, then you will make the interest computation on the opening balance of 2 lakh. Now let's just quickly assume it to be on the closing balance. We'll assume that 50,000 borrowing is at the beginning of the year only. Is the alternative assumption valid? Absolutely yes. The information is not available. On 2,50,000, I'll compute interest of 10%, which comes to 25,000. This 25,000 rupees of interest is already debited in P&L, because of which my profit has gone down. What should I be doing now? Because the profit has decreased, it is non-operating expense debited to P&L. I'll add back. And there is no information about interest outstanding. Is it there? Oh, we have an account. 20 and 25. Okay, actually assumption is not required because 25 closing is there. So let's say I'll assume current year expense of 25 is fully outstanding. Last year's interest of 20 is fully paid. This interest has to be on bank loan. This interest cannot be on debentures because debentures were issued only at the end of the year. So I'll assume and I'll compute interest on entire 2,50,000 closing balance, 25,000 current year expense completely outstanding, 20,000 last year's expense outstanding at the end of last year, paid currently. This 25 what is debited to P&L, I added back in operating activities. 20,000 last year's interest, what is paid here, what I have written here to bank, This financing outflow. I'll write in my financing activities, interest paid on bank loan 20. Question is over. All the working notes are over except only one. P&L account will find net profit as balancing figure. Dividend payable 50,000 of last year is now not outstanding. That only means that it is completely paid during the current year. This 50,000 of dividend paid is financing outflow. In my financing activities, I would write dividend paid 50,000 during the year. Any other ledger pending other than P&L? No, only P&L. Last year we had 60,000 worth of profit. Now it has become 1,10,000 in reserve. There is no dividend declared in current year. So the increase in the profit from 60 to 1,10,000 is basically the net profit for the current year. This is the starting point in computation of cash flow from what activities? Operating activities. Come to our cash flow statement, write net profit as per P&L 50. Take the total 50 plus 25 plus 30, 1,05,000. 1,05,000 minus 15, 90, 90 plus 30, 120, 120 minus 25, 95. 95 is the cash flow from operating activities. Did everyone get it? Then we have financing. Operating and financing are the only things that's been asked. Investing is not asked. Take 1 lakh plus 1 lakh, 2 lakh, 2 lakh plus 50, 250, 250 minus 50, 2 lakh, 2 lakh minus 20, 1 lakh 80. So cash flow from operating activities is 95 and cash flow from financing activities 1 lakh 80, and this is the answer to this. No, you don't have to add. That's it.
Come on guys, let's now solve question number 4 from our January 2025 examination. This question number 4 was on amalgamation topic, a 14 marker question where they've asked accounting in the books of transferor, transferee and in the amalgamated company. They've not asked much. See this, following are the summarized balance sheets of Light Limited and Bright Limited. Our question is in Light and Bright, who is transferor, who is transferee? We don't know right now. Scroll down, finish the balance sheet, come to the bottom, notes to accounts also, you just scroll it through. See, a company Rainbow Limited is formed, okay, to acquire assets and liabilities of both the companies. So Light to Bright to, both are transferors. Rainbow is transferee. There's a new company called transferee. What do they want? Read the last line, you'll understand their requirement. Realization account and equity shareholders account in the books of both Light and Bright. Both transferors, both the transferors, they're asking two ledger accounts, realization and equity shareholders, and opening balance sheet in the books of Rainbow. So we should prepare Light books only realization and equity shareholder account, in the books of Bright realization and equity shareholders account, and then balance sheet in the books of Rainbow with notes to accounts. They have not mentioned it, but we have to do a table computing NATO PC. I would very strongly recommend you to do it. If not, the chances of messing up in the answer will become more. You get this? I know CR7 is the best, but you should not mess up your answer. Come on. What is the name of the transferor? Light and Bright. Name of the transferee? Rainbow. Nature of amalgamation? We don't know. Too early to judge. It can be merger, it can be purchase. We'll see it later. Read adjustments, make any markings if there is any, and then start with the solution. So to acquire assets and liabilities of both the companies, assets are acquired at book value except land and building of Light. Wait. With regard to Light, it is not amalgamation nature of merger. Why? They are taking assets at book value except land and building. Land and building is taken at revalued figure of 62 lakhs. First, before we forget, here we'll write 62 lakh land and building of Light. This is not taken at 58. This is taken at what value? 62. 62. Okay, notes to accounts only mark madidini. ಇಲ್ಲಿ PP also I'll make a marking. This is value is changing. Then the next thing, what are they telling? Other assets of Bright Limited are absolute and scrapped and sold for 50,000 by Bright. Okay. Here you have other assets, no, of Bright 1.75. This is not taken over by new company. This is sold by old company only. So obviously what's happening here? Again, this is amalgamation nature of purchase. Are you getting it? Now there is one small element of doubt. All assets and liabilities are taken over. When this 1.75 worth of other asset is sold by Bright Limited, that consideration whatever they receive, Is that cash taken over by Bright? Is that cash taken over by Rainbow or not? They've not told. That absolute assets 1.75 is sold for 50,000. No. When that is sold, they would receive cash. Will that cash be taken over by Rainbow or not? They've not told. However, it doesn't matter. If that is taken over, that also transferred to realization. If that is not taken over, to that extent it is not transferred to realization, that 50,000 cash will be used to settle shareholders. It will come in shareholders account. The question is, should it come in shareholder or should it come in realization? This is one part where the mention is not made in the question. You have to make an assumption and mention it at the end of the question. What is your assumption? The assumption that I am going to deal is, it is like both the companies are coming together to form a new company. All the assets are taken over, including that bank balance or cash balance. So I am assuming that other assets are sold by Bright. That consideration what is arise is included in cash, or it is separately taken over by way of bank by the Rainbow Limited company. That is my assumption. However, let's wait and see what will the institute, because the day I am recording this is the one day after the examination is over. So I don't know when the suggested answer will come. By then, if there is any change, they would have treated the alternative assumption. But what I would want you to notice, whenever the paper is sent for correction, the evaluator who is correcting the paper will be given more than one correct answer. But the suggested answer what comes to you on the website will have only one correct answer. So there are a lot of times where your answer is not exactly suggested answer, because assumption, only one assumptive answer is mentioned in suggested answer. Alternative assumption wala answer will still get full marks because it is included in the evaluator's key answer sheet. Are you getting it? Let's further proceed. So I've made marking next to these two items because their value is changing. Light and Bright Limited will be issued 80,000 and 64,000 equity shares of rupees 100 each in Rainbow in lieu of their purchase consideration. This is like lump sum cum payment method. Lump sum because total amount is mentioned. They've given details of payment. So it is like lump sum cum payment. So I would write name of the transfer is Rainbow. Nature of amalgamation is purchase, because not all the assets are taken over in case of Bright. In the case of Light, assets are taken over other than at book value. One item, land and building. So all the 5 conditions are not fulfilled. Even if one is breached, purchase. Purchase consideration, we can call it, it's like lump sum amount is given and payment details are given between lump sum and payment method. And accounting in the books of transferor, Light and Bright, should be realization method. Accounting in the books of transferee should be purchase method. So shall we start with what they've asked us to do? They've asked us to do accounting in the books of Light, transferor. Remember to transfer all the assets and liabilities, whether taken over or not, at book value to realization account. All the assets and liabilities, whether taken over or not, at book value to realization account. That is the same language that we used in the revision video if you listen also. So you will get that right. So let's see property, plant and equipment. Let's start with assets. PPE will go to note number 3. Where do we go to? Note number 3. Come to note number 3. In note number 3, what assets do we have? 58, 7.5, 3.2, land and building, plant and machinery, other assets. Remember, land and building is taken over at agreed value, but when you transfer to realization, it has to be at book value. Agreed value will come only in the new company's books. All the adjustments given in the amalgamation question will be in transferee's books, not in transferor's books. All the assets, whether taken over or not, should be transferred at book value. What value? Book value. So entry will be, assets will have debit balance. We have to credit them and debit realization. Realization account debit 2 land and building, 2 plant and machinery, 2 other assets. Realization account debit 2 land and building, 2 plant and machinery, 2 other assets. Value 58.58 lakh, 7 lakh 50, 3 lakh 20. I am doing in the books of Light. After I finish Light, I will do Bright. Let's not mix up Light and Bright. Names is also confusing. Okay. So assets are transferred, PPE is transferred. Come to balance sheet here. PPE 68.7, this item done. See the next item. Inventory 5.75, trade receivable 4.3, cash and cash equivalent 3.15. Shall I transfer these 3 items also? Let me transfer. So I would write in my realization account debit to inventory, realization account debit to trade receivables, to cash and cash equivalent. Inventory 5,75,000, trade receivables 4,30,000, cash and cash equivalent 3,15,000. Khatam. All the assets are transferred. Balance sheet asset side, clean sweep. Now let's see liability side. Liability side, we have trade payables. What do we have? All the liabilities also should be transferred. Trade payables, long-term provisions. But when we say all the assets and liabilities should be transferred except capital and reserves, except capital, and they will be transferred to shareholders account. So I'll transfer 3.4 and 1.5 to realization. These both are liabilities, they have credit balance. In order to close them, I need to debit it. Journal entry will be long-term provision account debit, trade payable account debit to realization account. In realization account, I'll write by long-term provision, by trade payables. Amounts are 1,50,000 and 3,40,000. Is this right? Fantastic. By this, we are done with transfer of all assets and liabilities. Once all the assets and liabilities are transferred, you remember the story. Pack the assets, pack the liabilities into the box. Give the box to transferee company. Box is realization. Box is going out. Credit realization, debit rainbow. So journal entry is Rainbow Limited account debit to realization. In realization account, I will write by Rainbow Limited. If you remember the story, packing, giving, collecting, end of the problem. I will write here purchase consideration due. We are giving the box. We are expecting the PC. How much is PC? It's given in the question. Come here. They have told the purchase consideration is 80,000 shares to Light Limited, 64,000 shares to Bright Limited. 80,000 shares of rupees 100 each. So my consideration is 80,000 into 100. How much is 80,000 into 100? 80,000 shares into 100, 80 lakh. So I've written this. Next, I should receive the consideration. Am I right? When I should receive the consideration, journal entry, I'm waiting there. They will check the box and then they'll give me money. When they give me money, I will write the entry, whatever they give, equity shares, preference shares, debentures, cash, bank, debit, credit, their name, Rainbow Limited. In this case, we're receiving equity shares. Entry is equity shares account debit to, sorry, equity shares in Rainbow Limited account debit to Rainbow Limited. We are not preparing Rainbow Limited ledger. We are not preparing equity shares in Rainbow Limited ledger. So that entry I'll remember I have received, but I will not write it anyway. Later I will come back. If there is any assets not taken over, liabilities not taken over, I'll pay. There is all assets taken over, all liabilities taken over. In case of Bright Limited, other assets are not taken over. In case of Light, all assets and liabilities are taken over. I'll come back. When I come back, I'll pay realization expense, which is not given in this question. Then what will I do? I will close my shareholders balance. Everything in the balance sheet is gone, no, except share capital and reserves. How much share capital, how much reserves? Share capital 50, reserves 218, 7. These three items, I'll close them by transfer to shareholders account. All of these will have credit balance. I should debit it. Equity share capital debit, statutory reserve debit, general reserve debit, P&L account debit to shareholders account. In shareholders account, I'll write by equity share capital 50 lakh, by statutory reserve 2 lakh, by general reserve 18 lakh, by security premium 0. Baribeka 0 if you want me to. By P&L account 7 lakh. Everything is transferred. Now I need to settle them. Before I start giving them, I should first identify my realization profit or loss. I told no, we'll take all the debit, credit, do the calculator. That is when we do journal entry. Here very simple. You have the ledger ready. Take the total, identify the balance. Take the total 80 plus 3 lakh 40 plus 1 lakh 50. What do we get? 83, 84, 84 lakh 90. 84 lakh 90 on the credit side. Take the same total on the debit. Identify the balance as equity shareholder account. This is my realization profit because it's realization profit. Sorry. If it was on the other side, it would have been loss. How much is the profit? 3 lakh. So in realization account, you will write it as to equity shareholder. I had told you the journal entry, realization account debit to equity shareholder. In equity shareholder account, you will write by realization account. Okay, this is profit. If in case you are finding this approach slightly new, you can always go back and watch the quick revision video. It is taught in the same pattern in the form of a story, wherein you will be able to crack the question on amalgamation. About 15-20 minutes video. Realization account debit, sorry, equity shareholder account only will write by realization profit 3 lakh, profit is closed. Now, whatever we received as consideration from our shareholder, from our Rainbow Limited, we should give it to them. What had we received? Equity shares in Rainbow Limited. That is asset for us. Now we'll give it to these equity shareholders. Journal entry is equity shareholder account debit to, what did we receive? Equity shares in Rainbow Limited. We had received 80 lakh worth of shares. Check the total here. Is it 80 lakhs? Tada! This gets closed. Whatever we did in the last 10 minutes, we should repeat now. Sorry, last 5-6 minutes, we should repeat. Why? We did it for which company? Light. We should do the same thing for Bright. What should we do? Transfer all the assets to realization. All the assets. When they start marana, come from the beginning again. Notes to accounts. What are the assets that we have? 44 lakh land and building, 4.5 plant and machinery, 1.75 other assets. Remember, all the assets, whether taken over or not, should be transferred to realization at book value. Entry is realization account debit to land and building. Realization account debit to land and building 44, to plant and machinery 4.5, to other assets 1.7. Sir, but other assets is not taken over. Whether taken over or not, at book value, you should transfer. Khatam. All the assets transferred. Next, all the liabilities has to be transferred. Liabilities there. This is reserves. Come back to the balance sheet. We're done with this 50.25. Other assets that we have is 7.1, 5.8, 2.85. Inventory, trade receivables, cash and cash equivalent. Shall I transfer these? Okay. Again, these assets will be credited. Realization will be debited. Realization account debit to inventory 7 lakh 10, to trade receivables 5.8, to cash and cash equivalent 2 lakh 85. All assets done. Now liabilities. Liabilities, there is only one, yeah. Trade payables. Why? Long-term provisions is not there. This capital and reserve will be transferred to shareholder account. So what is the entry to transfer liabilities? Very simple. Liability has to be debited. Realization account has to be credited. Entry will be liability account debit to realization. In realization account, I'll write by trade payables, by trade payables. How much is by trade payables? 2 lakhs. Let me write here 2 lakhs. All the assets put into the box, all the liabilities put into the box. Box name is realization. Pack the box, give it to transferee, Rainbow. When you give it to them, box is going out. Credit realization, debit Rainbow. Rainbow Limited account debit to realization. In realization, I'll write by Rainbow. How much? 64 lakh. Why is this 64 lakh? That is the PC due. Shall we write this PC due? Oh, they've given here 64,000 shares. 64,000 shares is our PC. See, 64,000 shares into 100 rupees per share. 64,000 into 100, 64 lakh. I'll wait there. He will give me consideration in the form of equity shares. That journal entry is equity share in Rainbow account debit to Rainbow Limited. That will not come in realization account or equity shareholder account. We're actually preparing only two ledgers. That is what has been asked in the question. After that, I come back. Is there any assets not taken over? Yes. Other assets is not taken over by Rainbow. I will sell that. Am I right? At what value is it sold? They have told it is sold at rupees 50,000. When it is sold at 50, journal entry is bank account debit 50 to realization. We should not write other assets. Why? That other assets is already closed by transfer to realization. Any profit or loss also should be through realization. Just blindly write the entry for sale price. Don't try to identify profit or loss. I have taught this to you. Entry is bank account debit to realization. In realization account, you'll write by bank. This is for other assets sold. This is for other assets sold. Is to other assets value 50,000. Clear? In realization account, I have written by bank. Am I right? By this, that asset not taken is also over. Is there any realization expense incurred? No. I come back, then I'll start paying my equity shareholders. First, I'll identify money payable to equity shareholders. How do I identify? Transfer that share capital and reserves. 40, 15, 5, 4. This is the money belonging to equity shareholders. Transfer it to their capital. Sorry, shareholders account. Entry is equity share capital debit, general reserve debit, security premium debit, P&L account debit to equity shareholder. In equity shareholder account, I'll write by equity share capital, by general reserve, by security premium, by P&L. What is the values? Equity share capital 40, general reserve 15, security premium 5, P&L 4. Done. Next, I should close my realization account to identify profit or loss to transfer to shareholder. Check the totals here. 64, 66, 66 lakh 50. Deduct all of this, identify the profit. Yeah, this is the consideration from other assets. Correct? No. This is our realization profit or loss. Oh, wait. What we'll do is this bank consideration, whatever we receive 50, that is also taken over by them. No. So it is not like after that we sold it. We sold that and then we packed that cash also and sent it to them. If you don't, this 50,000 should be shared to shareholders. What I'll do is other assets are transferred. Now I'm going to transfer this bank 50,000, whatever as I have, also to our shareholder, also to our Rainbow Limited. I'm packing it and sending this also to them. I've sent 50,000 additionally to them. Now you won't get any realization profit or loss. It matches exactly. There is no realization profit or loss. If in case that 50,000 I keep it with me, that 50,000 will become my realization profit. I'll share it to my shareholders here, and 50,000 I'll pay to them using that bank balance here. So either book that as profit and pay 50,000 to my shareholders, or assume that that 50,000 is taken over by Rainbow Limited and give it to them. In this case, I mentioned it in the beginning of the question. I've assumed that this 50,000 consideration received on sale of other assets is sent to Rainbow Limited. If you make assumption that it is not given, this 2 bank 50,000 will appear in shareholders account, and here you will get realization profit that will be written here. 50 credit, 50 debit. It will match same to same. Both the cases you will be awarded full marks in the exam. Don't worry about the same. Understood? So realization profit or loss is not there. How much is the money that we should pay to equity shareholders? 40 plus 15, 55. 55 plus 9, 64. That is the exact value of equity shares that we got from Rainbow Limited. Give it to your equity shareholders. We are done with this problem when it comes to accounting in the books of transferor. They've asked us to do balance sheet in the books of transferring. Very sweet balance sheet. Whatever is transferred, you write all of those assets. But I will do it with notes to accounts. Before that, I'll do NATO. Can I? Come on, let's do NATO now. In the NATO, what would I write? I'll write all the assets taken over, all the liabilities taken over at the agreed values, and I will also write the PC to compare goodwill or capital reserve arising and then post it. Let's begin with this. This they have not asked. Begin with the assets in the balance sheet. What assets are there in the balance sheet? Land and building, 58. But this 58 has a star. Why? 58 is to be taken at what value? 58 is to be taken at 62. So I would write land and building is agreed to be taken at 62 lakhs. And what do we have? This 44. It's taken at 44. No problem. 62 plus 44, 1 crore 6 lakh. This 1 crore 6 lakh is what will appear in PPE, in consolidated, sorry, in a post amalgamation balance sheets, notes to accounts. After land and building, we have plant and machinery. Plant and machinery 7.5, 4.5. I would write them exactly same. Plant and machinery 7.5, 4.5, 1 lakh. Next asset, other assets. This other asset 1.75 is not taken over. Only 3.2 will come. Let me write other asset. I would write 3.2. I would not write 1.7. The total is 3.2. What other assets are taken over? Come back to the balance sheet. We are just done with PPE. Now inventory 5.75, 7.1. Taken over correctly at the same value. 5.75, 7.1, 12.85. Next, we have trade receivables taken over at 4.3 and 5.8. Trade receivables 4.3, 5.8, together 10.2. Then we have cash and cash equivalent. Cash and cash equivalent 3.15, 2.85 plus 50,000 bank balance taken over. So 3.15 plus 2.85 plus 50,000. So here it will be 3.15. No problem. Over it is 2.85 plus 50. How much is that? 3,35,000. 3,35,000. We have taken over Bright Limited's cash balance of 2,85,000 plus Bright Limited sold that other assets 1.2 lakhs for 50. So that 50 lakh also we took. So we took over 2.85 lakh plus 50,000. 3.35. Understood? Then if you take the total, you will get this is the value of the assets taken over. But this is not it. We need to deduct liabilities from this. That's when we get NATO. What liabilities are taken over? Trade payables 3.4 and 2. Long-term provisions 1.5 and 0. Let me write here. Trade payables 3.4 and 2. Together 5.4. Long-term provisions 1.5 and 0. 1.5. Deduct 1 crore 50 lakh 65,000 minus 6 lakh 90,000. You will get 1 crore 43 lakh 75. Over here 85 lakh 90 minus 3 lakh 40 minus 1 lakh 50, 81 lakh. 6475 minus 2 lakh 62 lakh 75,000. This is net assets taken over by Rainbow Limited. For this they have given purchase consideration. To Light Limited they gave 80,000 shares of 100. To Bright Limited they gave 64,000 shares. Together they have given 1,44,000 shares. This is 80 lakh. This is 64 lakh. If they have given excess consideration, it is goodwill. If they have given shortage consideration, it is capital reserve. See, assets taken over 81 lakh. Consideration given 80 lakh, we have given less. It is profit. PC is lesser than NATO, then that will lead to capital reserve of 1 lakh. In this case, assets taken over is 62 lakh 75,000. but you have actually paid 64 lakh. You paid 1,25,000 extra. That becomes goodwill. On the net in the Rainbow's balance sheet, we cannot write goodwill and capital reserve both. There is capital reserve of 1 lakh, goodwill of 1,25,000. I will write net 25,000 of goodwill. So this is actually the balance sheet of the Rainbow Limited. This much is assets. These two are liabilities. This is share capital. And this 25,000 will appear as an asset, goodwill. I would write this. So just keep this in mind and draw the balance sheet. I am telling you why you should do this NATO. There is no marks allocated for this. Once you do this NATO, when you're doing balance sheet, you just have to look at this. If in case you skip this, every time you have to see here and there, here and there, here and there. Chances of doing mistake will become higher. So please do NATO computation whether it is mentioned in the question or not. It will save time in preparation of balance sheet and notes to accounts. Let's start. Let's start with share capital. Share capital is this. This is share capital. Am I right? How much is share capital? 1 crore 44 lakh, which is 1,44,000 shares of rupees 100 each. I would write my share capital 1,44,000 shares of rupees 100 each, 1 crore 44 lakh. Mandatory disclosure, entire shares 1,44,000 is issued for non-cash consideration. I have to mention this. Done. 1 crore 44 lakh is the total of notes to accounts. It will go to share capital, note number 1. Then reserves. Is there any reserves in the question? Let's check. Statutory reserve is taken over. Statutory reserve has to be written. Remember DRUMSS. Yes, statutory reserve. How much is their statutory reserves? Their statutory reserves in reserves and surplus, irrespective of form of amalgamation, 2. But entry will be statutory reserve credit, debit will be amalgamation adjustment. This is the coolest reserves and surplus working note that you would ever see. I would write statutory reserve 2 lakh. I'll write amalgamation adjustment 2 lakh minus, it will be 0. If you don't write this, you lose 2 marks. But to write this, you won't even take 20 seconds. Plus alle minus alle, ultimately 0. What will come in balance sheet? Note number 2, 0. Then, is there long-term provisions? Yeah, long-term provisions is Barana. So, in our NATO, share capital over. Next, this is the long-term provision. So, LTP, long-term provision, minus 1,50,000. I would write minus 1,50,000 here. Long-term provision of Light Limited. That itself is the total that will appear in the balance sheet, long-term provision. Next, let's go to trade payables. Trade payables, we have it here in NATO. Observe, trade payables, TP. How much trade payables? 3,40,000 of Light, 2 lakh of Bright, together 5,40,000. Come here, trade payables, Light 3,40,000, Bright 2 lakh, putting it together 5,40,000. This 5,40,000 I would write here. Trade payables 5,40,000. Got this? That's it. Liability side done. Asset side, we have PPE, lot of items together. Land and building, plant and machinery, and other assets together. I would write it as PPE. Sir, why are you writing all 3 of them together? Because that's what they have done in the question. So I would write them together as PPE. How much? 62, 44, 750, 450, 320 and 0. I would also write it the same way. Observe. That of land and building of Light and Bright, 62 and 44, 1 crore 6. Plant and machinery, Light and Bright, 7,50,000 and 4,50,000, 12 lakh. And other assets only of Light, Bright because we did not take it over, 3,20,000. Total them, what do you get? 1 crore 6, 1 crore 18, 1 crore 21 lakh 20. 1 crore 21 lakh 20 will appear here as PPE, 1 crore 21 lakh 20. Intangible asset, ide, goodwill. Goodwill. Here I wrote goodwill. See, intangible asset. This intangible asset of 25,000, let me write in the balance sheet straight. I don't need a note to account for that. 25,000. Then inventory, note number 6. See, inventory, we have it here. How much is our inventory? Every place I'm writing it again and again in detail. You can write it much simpler when you write. This is ultimate detail, self-learning type. Just if someone sees the PDF only, they should understand the answer types. 12,85,000. Split is 575 and 710. I'll write inventory 575 and 710, 12,85,000. Posted to balance sheet, how much? Posted to balance sheet, inventory 12,85,000. Next, trade receivables, note number 7. How much is trade receivables? Come on, have a look here. Trade receivables, this is, there you go. trade receivables 10 lakh 10, which is 430 and 580. Right here, trade receivables 430, 580, 10 lakh 10. This 10 lakh 10 I would write here, trade receivables 10 lakh 10. Last item, cash and cash equivalent. Don't forget 50,000 other assets, sale consideration. I would have written here cash and cash equivalent. How much is it? 3 lakh 15 of light. Bright is 2 lakh 85 plus 30 plus 50,000. So 335. Together it is 6 lakh 50. I would post 6 lakh 50 here. Light 3 lakh 15. Bright 285 plus 15, 335. Together 6 lakh 50. This 6 lakh 50 would go here as 6 lakh 50. Everything's done, my friend. All that we need to do is take the total. Take the total on the liability side. 1 crore 44 lakh plus 1 lakh 50 plus 5 lakh 40. 1 crore 50 lakh 90,000 on the liability side. Take the total on the asset side. 1 crore 50 lakh. That's the tallying of your amalgamated balance sheet. Okay. Come on, guys. Let's now solve question number 5 from our Jan 2025 examination of advanced accounting. This question number 5 is on consolidation. A 14 marker question. Very easily doable question, not any tricky. No, there's no tricky adjustment which you can't handle and which you're seeing for the first time in this. With a good presence of mind, you should be able to do this question within time as well. Read the question. Summarize balance sheets of Super Limited and Clear Limited as on 31st March 2024 is given as follows. And Super Limited is the holding company, Clear Limited is the subsidiary. How do I say that? In Super Limited's balance sheet, on the asset side, there is investment, non-current investment, 41 lakh 50. This is investment in subsidiary. How do I know that? Scroll down below this table. They've given notes to accounts. Notes to accounts, they've told very clearly this investment what we made is investment in Clear Limited. Clear is the subsidiary. And they've also mentioned that Super Limited holds 75% of equity. However, we'll solve the question in the order. Shall we solve the question in the order? If you remember how we approached in the class, we should be always starting the question from the beginning. Item by item is how we see it. Starting with the first item, share capital. Our share capital of 95 lakh is our share capital. Go to note number 1 to see how is our share capital placed. Our share capital is placed like this. We have 8 lakh equity shares of rupees 10 each, which comes to 80 lakh. We have 15,000 preference shares of rupees 100 each, which comes to 15 lakh. Usually we used to not prepare notes to accounts for our share capital. But in this question, you have to prepare notes to accounts. Why? Our share capital has split 2 items. So in our share capital, I would write note number 1. This is our consolidated balance sheet as per Super Limited. In the notes to accounts, I would write A, equity share capital, which is 8 lakh equity shares of rupees 10 each, 80 lakh. And I would also write preference share capital, which is 15,000 preference shares of rupees 100 each, which comes to 15 lakh. Putting it together, 95 lakh is my share capital. I would write it. In fact, I would recommend you not to do the total at the end of this. Keep that open at the end after you finish reading the entire problem. That's when you should do the totaling. I would not want you to do the total right now. Proceeding further, let's see the share capital of the subsidiary, which comes to 50 lakh rupees, which is 5 lakh equity shares of rupees 10 each. This 5 lakh equity shares of rupees 10 each, which belongs to subsidiary, I am going to take up one note. After notes to accounts, I am going to take up analysis of share capital of subsidiary. I would write here 5 lakh equity shares of rupees 10 each, which comes to 50 lakh rupees. This is share capital of Clear Limited. Subsidiary's name is Clear Limited. By this, we are done with share capital. Once you finish notes to accounts, come back to the balance sheet only. Item number 1 done, which is share capital is done. Let's see the next item, reserves and surplus. In the reserves and surplus, we have our reserves 25 lakh 75,000 rupees. Our reserves, let's see what is the split for our reserves. Our reserves, we have general reserve and we also have P&L account. I've taught this to you in the past that if there is any unrealized profit arising on the sales made by the holding to the subsidiary on such stock left with subsidiary which is not sold to anybody else, holding company's profits has to be eliminated for downstream sale. Is there any downstream sale in this question? First adjustment talks about percentage of holding. Second one, mutual indebtedness. Third one, there is unrealized profit. Super limited sold inventory to clear. Super is holding, clear is subsidiary. So holding company has sold inventory to subsidiary and that inventory is remaining with subsidiary. There is unrealized profit. I will not read adjustment number C and then adjust right now. I'm only showing that that adjustment is there. So what do? When I write holding company's reserves, general reserve will go to outer column. P&L account, I'll park it in inner column. Later when I finish the balance sheet, come to adjustment, read the third adjustment, I'll eliminate that unrealized profit. Are you guys getting it? So what would I do? Here, when I write my reserves, in the balance sheet notes to accounts, I would write here reserves, general reserve, which is how much? 15,50,000. Holding company, 15,50,000. And profit and loss, I would write 10,25,000 in the inner column. From this, I will eliminate unrealized profit. So till then, let it be in inner column. And whatever is subsidiaries portion of 6,50,000 and 5,75,000, we will write them outside, waiting to be split into pre-post, and later split between holding minority. Yeah, if in case you would want to understand this approach of solving the answer, you would have to go back and then watch a revision video. Search for quick revision video on accounting standard 21, you will get it, and that will tell how exactly is this approach done. I would write general reserve 6,50,000 of subsidiary and P&L account 5,75,000 of subsidiary. First I'll split this into pre-post, then I'll split it between holding minority. When will I do it? When I get sufficient information. Right now I don't have information. I'll just write reserves of subsidiary, that is what limited? Clear limited, and leave it that way. We will do the rest later. Come back to the question. So if you go, this is notes to accounts. If I go to balance sheet, reserves and surplus is been taken care of. So don't worry. Come to long-term borrowing, note number 3. Shall we go to note number 3? Come to note number 3. We have long-term borrowings 5 lakh. Long-term borrowing so much? 5 lakhs. And subsidiaries long-term borrowing 2 lakh. We saw the adjustments. There is no investment made by holding in subsidiaries debentures. Literally had holdings debentures, subsidiaries debentures together and then write them in the balance sheet. This needs no adjustment. Come to balance sheet. I'll route it through notes to accounts. I would write 10% debentures 5 lakh, and I would also write 9% debentures 2 lakh, stitching it them together 7 lakh is my long-term borrowing. And in my balance sheet I would write long-term borrowing. I would write later. I'll write notes to accounts totals later. What if there is some adjustment? I know it's not there, but I would not recommend you to close the notes to accounts anytime before completion of the answer. After you finish the entire question reading only, you should close the notes. Done. This way, if you do, there is no way your consolidated balance sheet will not tally, irrespective of the level of the question and complexity in the question or length of the question. Come back to the question now. Again, we are not dealing with notes. I came back to balance sheet all again. There is short-term borrowings. Short-term borrowings is 4,50,000 of mine, nothing of subsidiary, 4,50,000 plus 0. 4,50,000 will be my borrowings in consolidated balance sheet. I don't even need notes to accounts. Why? In the question only they have not given notes and there is no adjustment. Why do I have to prepare notes? I'll straight away write 4,50,000 in the amount column. Then I have with me trade payables. Trade payables 3,65,000 of mine, 2,45,000 of subsidiary. But there is mutual indebtedness. Holding company super limited has sold goods to subsidiary. So subsidiary's trade payable is some part towards holding. So holding's trade payable has no adjustment. Subsidiary's trade payable has an adjustment. So next to trade payables, I will write one note. We did one note for reserves and surplus, one note for long-term borrowings. Next note is for trade payables. Note number 4. Come on, let's go to note number 4. Trade payables. How much is that of super limited? Super limited's trade payable 3,65,000. There is no adjustment here. Why? Super is holding. Holding has sold goods to subsidiary. So subsidiary has to pay to holding. To subsidiary it is trade payable. To holding it is trade receivable. Mutual indebtedness in this downstream transaction will be eliminated from payable of subsidiary and receivable of holding. Super is holding. Super's payable has no adjustment. Then clear limited's payables 2,45,000 will remain in inner column because from this I have to eliminate mutual indebtedness. We'll eliminate this later. Now we are done with the liability side of balance sheet. Let's go to asset side. When we start with asset side, property, plant and equipment. Note number 4. Shall we go to note number 4? Come to note number 4, you have the details. Land and building, plant and machinery, furniture and fittings. This question, like we saw, there are 3 adjustments A, B, C. There is no revaluation of assets. So I will take line to line total. 65 plus 45, 50 is land and building. So I am writing in note number 5. Let me write here land and building. Super clear. 65 and 45, 50. Together comes to 1 crore 10 lakh 50,000. After this, I look at plant and machinery. Holdings plant and machinery 9 lakh 50. Subsidiaries plant and machinery 6 lakh 75. I would write plant and machinery super and clear 9 lakh 50 and 6 lakh 75 together 16 lakh 25,000. No adjustment, no revaluation in this. But do you know how to deal with revaluation? Upward, downward, with depreciation, without depreciation? We've been trained for it, but we don't have that adjustment in this question. Furniture and fittings 2 lakh 50 hours, 1 lakh 75 theirs. Now both are hours. Let me write in my PPE super clear 250 175 together 425. There is no other asset arising. I can total this and post it right now, but however I'll keep it to later. But in this question I'm very confident there is no other adjustments. I would strongly recommend you not to total it. I would want you to total it only after you finish reading the entire question. Got that? Next, after this we will go back to the beginning of the question again, means balance sheet. We are done with this 77 lakh and 54 lakh. Next we have non-current investments, note number 5, 41 lakh 50. Come to note number 5 in notes to accounts. In notes to accounts, if you come down, you will find investment in subsidiary. How much is investment in subsidiary clear limited? Investment in subsidiary clear limited is 41 lakh 50,000. This is book value of investment. If you remember in our revision video also I have told very clearly 41 lakh 50 should go to cost of control, book value, asset. This will be compared with nominal value, liability. If liability is more, capital reserve. If asset is more, goodwill. Right now we don't know nominal value. Right now we don't know, so we will not write it. I know 41 lakh 50 is my book value. I will write 41 lakh 50. Another thing that I told you is this book value should be adjusted for holding company share in pre-acquisition reserves, and it should also be adjusted against pre-acquisition dividend. In this question there is no pre-acquisition dividend. In this question actually there is no pre-acquisition reserves also, but I don't know. I'll keep it in inner column. Why? I don't know it. Why? I'm still in balance sheet. When do we get to know that there is no pre-acquisition reserves? Only when we read adjustments. I have read adjustments before, so I know. But you are reading this question first time. You don't know. So you write in inner column. Later when pre-acquisition reserve is 0, we'll write minus 0. Okay, 41 lakh 50. After this, what do we have? Come to this additional piece of information. Super limit. Oh, no. Balance sheet. Notes to account in the balance sheet go beku. Balance sheet ella mugibeku. So this is done. We still have 3 items in balance sheet for which notes to accounts are not there. What are they? Inventory. How much is our inventory? 6 lakh 75. Their inventory. I should add them together and then write in balance sheet. However, subsidiaries inventory 5 lakh 65 constitutes certain inventory which the holding company has sent to subsidiary, which the subsidiary has not sold to outsiders. Because this is inventory sent by holding company has booked some profit on it. Subsidiary has not realized this profit. Such profit should be eliminated from inventory of subsidiary, profit of holding. In the revision video I had told sending companies profit, receiving companies inventory. Sending companies profit, receiving companies, here sending companies holding companies profit I need to eliminate. Receiving companies subsidiaries inventory I should eliminate. But I don't know the profit element right now. When will I get to know? When I come to adjustment. Right now what will I do? I'll write 6 lakh 75 in outer column, 5 lakh 65 in inner column. Come back here, notes to accounts. We're done with trade payable, PPE done, note number 5. Then note number 6, inventory. Note number 6, inventory. I would write here that of super limited has no adjustment, 6 lakh 75 outer column. That of clear limited amount of 5 lakh 65 will stay in inner column. I will eliminate unrealized profit after we read the adjustment and then post it. Till then you guys would have to wait. What do we have after inventory? One more item in the balance sheet, trade receivables. What do we have next item? Yeah, trade receivables. How much is ours? 5 lakh 85. How much is theirs? 4 lakh 90. We need to add them together and write. But there is mutual indebtedness. Goods are sold by holding to subsidiary. Subsidiaries trade payable, there is mutual indebtedness. Holdings trade receivables, there is mutual indebtedness. So 5 lakh 85 needs to wait in the inner column to be deducted, and our what is that other item 4 lakh 90 is ready, happy to go to outer column. Super limited 585 inner column, and then our clear limited 4 lakh 90 outer column. If you check trade payables of subsidiary was in inner column, holding was in outer column. So trade payables of subsidiary, trade receivables of holding, we need to eliminate mutual indebtedness. Got it? What's after that? Cash and cash equivalent. Ours 2 lakh 80, theirs 2 lakh 15. There is no dividend, there is no payments. So 280 plus 215 straight can go to balance sheet. I would open one more notes to accounts. Last one, cash and cash equivalent. Super 280, clear 215, together 495. In fact, I would recommend you not to do the total right now. We'll do the total later and then post it at the end. This is a simpler problem, but if in case there was an adjustment, how to deal also, you should be mentally prepared. Got it? Yes. We are done with the balance sheet. Enter notes to accounts is also taken care of. Now we'll read adjustment. Super limited holds 75% of equity shares. How much do we hold? 75% of equity shares. So when we hold 75% of equity shares, come to your cost of control or shareholding here. Holding company, that is, what is the name of the holding company? Super limited holds so much? 75%. Apply 75% on 5 lakh. What do we get? 30 lakh. 37 lakh 50,000 rupees, which is 3 lakh 75,000 shares. If we hold 75%, minority holds 25%, which comes to 1 lakh 25,000 shares, which is 12 lakh 50,000 rupees. You guys understood this? What I would do with this is, this 37 lakh 50 will become nominal value of investment. You remember, nominal value of investment, liability from the subsidiary's balance sheet represents liability. Book value of investment, asset side of holding company, asset. We compare them to find goodwill or capital reserve. The table where we compute goodwill or capital reserve is called as cost of control. This will go to outer column. But you remember me telling in the revision video also, we told that 37 lakh 50 should be written in the inner column, adjusted against bonus issue if it is declared after date of acquisition, before balance sheet or consolidation date. Here that's not there, no bonus issue. So 37 lakh 50 outer column. Got it? Tell something. Very nice. What's after this item? So come back to the question again. This minority interest, I'll write in minority interest table. 12 lakh 50. This minority interest, I've written only share capital. I would have to later add the reserve share belonging to minority, total them and write it as a separate line item in balance sheet. Understood? What is the next item after this share capital and after this 12 lakh 50 what we wrote here? This 75% and 25% is very crucial. In share capital analysis, there was one box, there I wrote percentage has to be computed so that we can take it for what analysis? Reserve analysis. This 75%, 25% will go to our reserve analysis table, where I'll write 75%, 25% is the ratio in which money will be shared between holding and minority. What money? Subsidiaries, reserves. After this first point, and continue this point of equity shares in Clear Limited, since the incorporation, Clear Limited got incorporated, it became our subsidiary. The day it got incorporated, it became our subsidiary. So on the date of incorporation, reserves were 0. So entire profits will be always post. Usually they used to mention in the question, no, these many reserves were there on the date of acquisition. Balance we used to write as post. Here on the date of acquisition, reserves are 0. So entire reserve of 6 lakh 50 general reserve is post acquisition. And here also this P&L is there, no, pre-acquisition is 0. Why? The moment it got incorporated, we acquired shares in it. So entire 5,75,000 is post acquisition. Did everyone get this? Very nice. So we'll just check the other adjustments and then finally make this correction. Right now I feel like taking capital reserve revenues or taking into reserve analysis. But in this question it's not there. But what if there are some more adjustments for subsidiaries reserves? There is any dividend declaration, bonus issue, unrealized profit upstream or anything. So let's keep it open till then. Come to second adjustment, B. 25% of trade receivables of Super Limited is due from Clear Limited. Super Limited trade receivables is there. No, in the 25% is from Clear. Come to Super Limited, 5,85,000 in the 25%. How much? 25% comes to how much? 1,46,250. I'll deduct it. because it is mutual indebtedness. This money is receivable from clear. So if I eliminate it, I'll get 4,38,750 here. This 146,250 is eliminated from trade receivables of super. This should be eliminated from trade payables of clear. Come to clear limited's trade payables. Here I will eliminate less mutual indebtedness 146,250 to arrive at 98,750 to be trade payables of clear limited. Is it clear? What do we have after that? During the year, Super Limited sold inventory costing 2 lakh. How much is the inventory sold? 2 lakh. To whom? To Clear Limited. At a price of 15% above cost. 15% above cost. And this 2 lakh is also cost. They've told costing 2 lakh. Not value 2 lakh or not sale price 2 lakh. Come to the table. I'll make a simple table for your analysis of profits. See, if the cost is 100, profit is 15, sale is 115. Because 15% is on cost. And the goods are sold costing 2 lakh. Meaning cost is 2 lakh. If the cost is 2 lakh, how much is profit? 100 ಗೆ 15 ಅಂದರೆ 2 lakh ಗೆ ಎಷ್ಟು? ಇಷ್ಟಕ್ಕೆ ಇಷ್ಟಾದರೆ ಇಷ್ಟಕ್ಕೆ ಎಷ್ಟು? 2 lakh into 15 by 100. 30,000. 2 lakh into 15 by 100. 26,000. God. 2 lakh into 15 by 100 is how much? 30,000. 30,000 is unrealized profit. If you got 26,000 or something, you've taken this 2 lakh as sale price. You've done 2 lakh into 15 by 115. They've played a trick by making it simple, by making it cost. 2 lakh is cost, not sale value. So, goods sold by holding to subsidiary, which is remaining with the subsidiary, is 2 lakhs. On the 2 lakh, 30,000 profit would be booked by holding company. And 30,000 inventory of subsidiary will be more. This is downstream. So this 30,000 should be eliminated from inventory of buying company, which is subsidiary, profit of selling company, which is holding. Shall we do that? See, the entire inventory remains unsold. If they would have told 80%, 50%, then we are supposed to compute it further. So let's eliminate this 30 from two places. Where? Inventory of subsidiary. Inventory of subsidiary clear limited, unrealized profit 30, making it 535. This 30 should be further deducted from profit of holding. Holding company's profit is there in reserves and surplus. Here 10 lakh 25 is there, no? I would deduct less unrealized profit 30, making it 9 lakh 90. Come back to the question. That's it. You are required to prepare consolidated balance sheet of Super Limited. I have almost every piece of data that is required to solve this problem ready in my hand. I don't want the question paper anymore. Come to our answer script. Quickly see this. I will analyze our reserves. Start with reserves, minority interest, and then end with notes to accounts. This pre-acquisition is capital reserve. This pre-acquisition is capital reserve. So capital reserve is 0 plus 0. Can I take 0? 0 shared between holding and minority in ratio 75-25. 0 into 75% is 0. 0 into 25% is 0. Then post acquisition 6 lakh 50 revenue reserve. Post acquisition 5 lakh 75 revenue reserve. Total then 6 lakh 50 plus 5 lakh 75. 12 lakh 25,000. Share it between holding and minorities 75-25. 9 lakh 18,750. 3 lakh 6,250. 9 lakh 18,750 what belongs to holding has to be taken to revenue reserve. No, let's start with order. Pre-acquisition reserve belonging to holding is 0. In cost of control from book value, I have to deduct 0, making 41 lakh 50 as my asset, 37 lakh 50 as my liability. Now, which is more? Asset is more. Asset is goodwill. If it was liability is more, then it would have become capital reserve. How much will be our goodwill? 4150 minus 3750, which is 4 lakh. This will go to balance sheet intangible asset. There is no need to do notes to account. Straight away right here, property, plant and equipment kelagade, intangible assets, goodwill 4 lakh. Got it? So I am done with holding company share in the pre-acquisition. Holding company share in post-acquisition reserve next. 9 lakh 18,750. This is holding company share in post-acquisition reserves. What do I do with this 918,750? I'll take it to reserves and surplus. Come on, let's go to reserves and surplus. In our reserves and surplus, I would write here revenue reserve 9 lakh 18,750. Then, shall we see minority share? Come back to the same table. Minority share 0 and 306,250. I would add capital reserve 0, revenue reserve 306,250. We have discussed this repeatedly that For minority, it doesn't really matter whether it is capital reserve or revenue reserve. Total the minority share 15,56,250. This is a separate line item in our balance sheet. Come to balance sheet, I would write here a separate line item, minority interest 15,56,250. Got it? All the working notes are done. Now only notes to accounts needs to be totaled. Share capital 95 lakh. Let me write note number 1, share capital 95 lakh. Note number 2, reserves and surplus. See reserves and surplus 1550, 995 plus 918, 750. 34 lakh 63 750. Let's write 34 lakh 63,750 our reserves and surplus. Come to long term borrowing. Shall we go to long term borrowing? Long term borrowing number 3. How much? 7. Let me write long term borrowing 7. Short term borrowing is already written. Now let's write trade payables. Come to trade payables 3 lakh 65 plus 98,750. 4 lakh 63,750 of trade payables. I will write here 4 lakh 63,750. Don't total the liability side. We'll total it later so that we can celebrate. Come to balance sheet asset side, property, plant and equipment, note number 5. 1 crore 10 lakh 50 plus 16 lakh 25,000 plus 4 lakh 25,000. 1 crore 31 lakh, 1 crore 31 lakh will be written as property, plant and equipment. Let's write inventory now. Let's see inventory. We still have trade receivables and cash equivalent also. 6, 7, 8. Sixth one. How much is inventory? 675 plus 535. 12 lakh 10,000 will be posted to balance sheet as inventory. Now next, Tala for a reason. Will play every season. Yeah. Trade receivables 438 750 plus 4 lakh 90. 9 lakh 28,750 will write it as trade receivables. Lastly, I have cash and cash equivalent. Come on, note number 8. 4 lakh 95,000 I would write here. Let's take the total on the balance sheet liability side. Help me with the total. 1 crore 61 lakh 33,750. Total on the asset side 1 crore 61 lakh 33,750, and then a consolidated balance sheet tallied. Let's now solve question number 6a. This is an internal choice based question. 6a, there were 2 questions in the question paper. One question was on AS 18. The second question is on framework for preparation and presentation of financial statements. Chapter 2 of your syllabus from our January 2025 examination. In this question, they are requesting you to prepare, or they are asking you to prepare profit and loss account. You don't have to follow schedule 3 format. You don't have to do vertical format. You would have to do horizontal format. But the thing in this question is the organization is not a going concern. When the organization is a going concern, we apply concept of conservatism. We apply historical cost concept. But the moment the organization is not a going concern, all of these concepts will go. Would have to value every item in the balance sheet, every item in the balance sheet at net realizable value or settlement price, or to say the price at which it will be settled. When we do this, the change in the value, in the decrease, if it is decrease in the value of the asset, it will become loss, it will go to P&L. And when you're settling a liability, if you have to settle the liability at a higher price, such excess amount that you should pay will also become loss. If the liability has to be settled right now, and if you are expecting to get some discount, that discount should be booked in our P&L against conservatism. Usually if there is discount on creditors, we book it at the time of settlement. Here we should book that discount even before we settle it. Why? Because our going concern concept is taken for a toss. We are booking profit against conservatism. We are recording assets at NRV. Fixed assets will not be recorded at historical cost. It will be recorded at NRV. We've done this in chapter 2. We did this unit, you remember? And here we discussed very clearly how do we value items when there is going concern, how do we value items when there is when it is not a going concern, and when there is change in the value from historical cost to its replacement price, settlement price or NRV. Such decrease in the value of the asset is loss, P&L debit. Such increase in the value of the asset is profit, and ulta with regard to liability. Can we start with the question? See, given below is the balance sheet of Sky and Associates as on 31st of March 2023. Don't waste time on balance sheet. Read what's given after that. First read the last line. You are required to prepare profit and loss account for the year ended 31st of March 2024 to ascertain the profit or loss for the period. And now we'll read the question. Additional information point number 1. The firm is planning to shut down its business with immediate effect. Going concern is not there, so we prepare P&L, revaluing all the assets and liabilities to settlement price or NRV. The sale and purchase of the firm is like this. Sale is 8,20,000, purchase is 6,50,000. Let's write this sale and purchase. I am not just preparing P&L, I am preparing trading cum P&L. In my trading cum P&L, on the debit side, I would write opening stock, which I don't know right now. So right now I'll write purchases, which I know. Purchases is 6,50,000, sales is 8,20,000. Purchases 6,50,000, sales 8,20,000. Done. After these two items, value of the closing stock as on 31st of March 2024 is 65. See, usually our closing stock will be valued at cost or NRV, whichever is less. This is keeping in mind accounting standard to paragraph 5. But because my organization is not a going concern, I am acting mad. I don't want to do cost or NRV, whichever is less. Irrespective of which is low, I will value it at NRV. Even if NRV is more than cost, I will still value it at NRV. Sir, conservatism. That's what I told you in the beginning. Conservatism illa. So how much is the cost? 65,000. NRV is 120% of cost. 120% means 20% more than cost. Do you agree with me? So please identify closing stock for me. 65,000 into 120%. What do I get? By closing stock, I'll write 65,000 into 120%, which is 78,000. I've recorded it at a higher value. Did everyone get this? Pakka. Come on, let's go to the next aspect. What do we have after that? They have given the next point, which says other expenses for the period is 25,000. Now I have to make an assumption whether this other expenses is direct in nature or indirect in nature. There's going to be no marks allocated for GP being right. I will assume that other expenses to be indirect expense. I would write here other expenses being 25,000 in my P&L account debit side. Got it? What do we have after that? Deferred expenditure is getting amortized over 5 years starting from 31st of March 2022. In my balance sheet, I have here deferred expenditure of 9,000. I am writing it over 5 years. Every year I'll write 1/5, 1/5, 1/5. Now they started in 2022. I am in 2023. So 2 years is over. That remaining 9,000 should be written off over 3 years. 3,000, 3,000, 3,000. Do you agree with me? That if I have going concern, I've gone mad, I'm closing my business in next 1 year or within next few days, there is no going concern. So do I have 3 more years to write off? No, I will write off entire money now only. Usually we would have written 9,000 to P&L over 3 years. Now what will I do? Full 9,000 one day year only. My tash. Shall I write? I'll write in expense, deferred expenditure 9,000. Understood? Then what do we have after this? After this, they've given some adjustment with regard to remaining useful life of the machinery is expected to be 3 years. This is basically they're telling us how to revalue how to depreciate the machine. But we do depreciation when we are going to continue the business. When we are not going to continue the business, next year, in the beginning only, I'll sell my asset. Right now only I'll identify the sale price. I'll compare the cost value of the asset with selling price. I will change the cost to selling price. Any difference will be profit or loss. Because 100% sure I will sell it. If there is profit, book it now. If there is loss, book it now. Are you getting it? Read this. The realizable value of the machinery is expected to be how much? 1,65,000. An expense of 5,000 is to be incurred to realize the same. So I can sell the machine at 1,65,000. But to sell it at 1,65,000, I should incur expense of 5. Sale price 1,65,000. Selling expense 5,000. You tell me how much is net realizable value? 1,60,000. On the net, I'll realize only 1,60,000 from the asset. What is the cost of the asset? Book value of the asset, not cost, book value. 1,80,000. So asset which is there in my books of accounts at 1,80,000, I'll sell it at 1,65,000 by incurring 5,000 expense. I'll realize only 1,60,000. So how much is the difference? 20,000 loss. Am I right? Book that 20,000 now only. Or in another way, revalue the asset from 1,80,000 to 1,60,000 to NRV. NRV is 165 minus 5, 160. I want to revalue my machinery from 180 to 160. When I should do revaluation, machinery value will reduce. Machinery credit, P&L debit. That is like depreciation. In P&L account debit side, I would write here to machinery 1,80,000 minus of 165 minus 5. 165 selling price, 5 selling expense, 160 is NRV. If I deduct it, 20,000 expense. What's after that? Come back, 6 adjustments over. See, so soon 6 adjustments passed by. Out of trade receivables, 5,000 is expected to be unrealizable due to an ongoing dispute. They were expecting continuous services from us. Because we are shutting down the business very soon, they are disputing with us and they might not pay 5,000. What to do? Bad debts. Bad debts or provision for bad debts. Provision for doubtful debts. How much? 5,000. Our debtors will decrease by that extent. Next, bank has charged a penalty of 2,500 for crossing the overdraft limit. Oh, you're in Lakshman Rekha. We've crossed the limit of overdraft. So they have charged us how much limit? 2,500. See, when they give limit of 10 lakh, we should only withdraw 10 lakh. If we overdraw the overdraft, they will charge us penalty like this, 2,500. Expense, I have written P&L account debit side. Next, the lender agreed to forgo 50% of the interest charge. Wow, what a Devata Manashya. Here we have interest charges. Where is it? 8% on the loan I should pay. No, I have taken loan of 40,000. On that 8% is how much? 3,200 I should pay. They looked at our condition. They're like, okay, you pay me 50%. Saku. In 3,200 we should pay only 1,600. So 1,600 is the expense that I would write here. If they would have not told this, I would have written full 40,000 into 80%, 3,200 as my interest expense. I am not writing the foregone percent. I am writing the expense that is supposed to be paid. Not paid, liability. If in case they'd asked us to prepare balance sheet, in that balance sheet I would have written outstanding interest 1,600. I am supposed to pay. Understood this? Alternatively, instead of writing 1,600 as expense, we can write 3,200 as expense and 1,600 as income. It's the same. Then what do we have? 6th one done, 7th one done, 8th one done, 9th one done. Last point, 10. Firm is expecting discount of 4,000 on creditors in full and final settlement. I am supposed to pay my creditors. No, I would have paid after 2 years or 3 years. But because I am shutting my business down, I would pay them immediately. They are so happy that they are giving me 4,000 discount. They have not given me discount yet. They are going to give. I am expecting. I'll still record it. Sir, but isn't this against conservatism? Yes, it is against conservatism. It is against going concern also. No. So once you cross the line, you cross all the lines. Okay? We'll book that profit of 4,000. That's it. They've asked us to prepare PL. PL is ready. Ta-da! So opening stock is 0. Oh, opening stock is given or not? It's given. This balance sheet here is beginning 31st of March 2023. So this is our opening stock. How much is the opening stock here? 1,15,000. Closing stock kottidare elladru? Have they given any closing stock information? Closing stock is 65,000 into 120%. We have it. We've taken. Come on, identify our gross profit. 820 plus 78, 898. 898 minus 7,65,000. 1,33,000 is our gross profit. I bring it down here. You can skip the trading P&L bifurcation. You can treat them as one single problem and still do. 1,37,000 here. 1,37,000 here. You tell me how much is the net profit to be carried down. 1,37,000 minus 25 minus 9 minus 20 minus 5 minus 2.5 minus 1.6. Tada! 73,900 is your profit. Let's start with question 6B from our Jan 2025 examination paper. This question 6B is from the topic of buyback. This question, they've given us the information, they're expecting us to pass the journal entries. They're not asking us to use our skills to compute the maximum permissible buyback. No, they've told, they've decided we should only do accounting. We're not in judging position, we're not in commenting position or suggesting position. We're only in accounting position. Shall we see this? Read the question. Following information are available in respect of Z Limited. That's the name of the company as on 31st of March 2024. Now, if you see at the end, you are required to pass necessary journal entries. Okay, let's do the same. This is information, extract of the balance sheet given to you. Don't read that, waste of time. Quickly read what's given below this. The company decides to buy back 20%. Can they buy back 20? Oh yeah. They have passed the necessary resolution, huh? Don't worry. 20% of equity share capital at 50. 15 is buyback price. 15 is buyback price. Now, take this. How many shares are there? 4 lakh. In 4 lakh, we are buying back 20%. That is 80,000 equity shares is what we are buying back. Come down. On 1st of April 2024. They have given date. Always write journal entry with date column. Don't skip date column. Or you can skip it if they have not given any other date. Buyback is as per provisions of Companies Act. Silent agi journal entry pass ಮಾಡಿ ಅಂತ ಹೇಳ್ತಿದ್ದಾರೆ. And company passed the necessary resolution for it. For this purpose, it sold 40 lakhs worth of investments for 32 lakhs. First write the sale entry. They have sold the investments. What is the value of the investments sold? Book value 40 lakhs, selling price 32 lakhs. They have not given any other date, only one date, so no need of date column. So let's write the journal entry. Bank account debit. How much? 40 lakh rupees is the value of the investment sold, but consideration received is 32 lakh. 32 lakh bank account debit. Investment will be credited to the extent of 40 lakh. This gap is there no of 8 lakhs. To that extent of 8 lakhs where you don't receive anything, debit will be loss debited to P&L, being investment sold. Now I have money. Now I am ready to do buyback. When I am ready to do buyback, my share capital will decrease. I will debit my equity share capital account. Number of equity shares that is there is 4 lakh. I am buying back 80%. Do 4 lakh into 20%. Sorry, 80% is not. Sorry, 4 lakh into 20%. 80,000 shares. Each share is of rupees 10. Share capital account debit will be always at nominal value. I'll do 4 lakh shares into 20% into rupees 10 per share, which comes to 8 lakh rupees. But am I buying back at 10 rupees? No, I'm buying back at 15. 5 rupees extra that I pay becomes premium. Premium is expense to me. I will not rate security premium, I will not rate P&L. I should first rate premium on buyback account. Later I'll adjust with security premium. To begin with, I should write it as premium on buyback. How much premium? 5 rupees per share for 80,000 shares. Sir, how did you get 80? Same, yeah, 4 lakh into 20%. 4 lakh into 20% is the number of shares multiplied by 5, you will get 4 lakh. Ultimately, I have to pay money to equity shareholder for purpose of shares bought back. I will create shares bought back account. How much money am I supposed to pay on the shares bought back? 4 lakh into 20%, 80,000 shares into 15 rupees per share. I will write 80,000 shares into rupees 15 per share. How much is that? 12 lakh rupees. This is due entry. This is not the payment entry. After this, when I make the payment, the shares bought back what I had credited here, I would debit it by 12 lakh and I would credit bank account by 12 lakh. This is the payment entry. Everyone got this? By doing this, my capital of the company has gone down. Capital of the company can never decrease other than by way of capital reduction approved by the court of law. That is internal reconstruction. Here, am I doing internal reconstruction? No, I am doing only buyback. By way of buyback, can the capital decrease? No, never. It should not. So what to do? Compliance of section 69, subsection 1 of Companies Act 2013. We have to create CRR. We have to create. Are we freshly issuing any shares for the purpose of buyback? No. We're only buying back shares by using consideration from sale of investments. My share capital is decreasing by 8 lakh rupees. How much is it decreasing by? So I have to create CRR for how much? 8 lakh. And in this process, this premium on buyback 4 lakh also I'll transfer to my security premium. So I would write that as premium on buyback account credit 4 lakh. And do we have security premium? Yeah, 6 lakh is there. How much is there? 6 lakh. Can I take 4 lakh from the 6 lakh? I'm not asking you, I'm asking security premium. Can I take 4 lakh? It tells yes. You did not hear? Okay. 4 lakh taken from security premium. Wow, sir. Wow. 4 lakh I have taken. Next, shall we create CRR for 8 lakh? CRR 8 lakh, I will credit it. Where will I take money from? I should take money from free reserves. Free reserves means general reserve and P&L. It will also include dividend equalization fund and revenue reserve if that name is used. But that nomenclature is not allowed. But if still the question mentions, take it. Here what do we have? Do we have? Yeah. Revenue reserve. See, I told you should not take. We discussed in schedule 3 the names that can be used in reserves. In that revenue reserve is not there. Bidi, we can't correct them. ಜನಕ್ಕೆ ಬುದ್ಧಿ ಹೇಳಿ 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 ನನ್ನ ಜೀವನನೇ ಹಾಳಾಗೋಗಿದೆ. ಮತ್ತೆ ಕೇಳ್ತಾರೆ ರೋಡಲ್ಲಿ ಜನ ಹೆಂಗಿದ್ದೀರಾ ಸರ್ ಅಂತ. ಏನು ಹೇಳೋದು? I'll take 50 lakh ಇದೆ. How much do I want? 8 lakh. Remaining 42 lakh you only keep. I will take how much? Yeah, 8 lakh. Sir, shouldn't we be taking P&L? You can take P&L. But first we'll exhaust general reserve and then come to P&L. That revenue reserve is nothing but general reserve. And actually we are done. Sir, ashte. Let's now solve question number 6C from the branch accounting chapter. Branch accounting chapter, this question is from independent branch, where the branch is maintaining its own records. It is not dependent upon head office for maintaining its records. And they've asked journal entries with narration. Even if they would have not used the word with narration, would have still written narration. In the books of independent branch for the business, to rectify or adjust the following. Basically, head office has been not maintaining books of the branch. Branch is maintaining its own books, and branch by mistake has done some mistakes. So what should we do? We should pass rectification entries to rectify such mistakes or to reconcile such differences between head office and branch. Read the first one. Commission income of 7,500 allocated to branch by head office, but no entry has been passed in the books of branch. Branch has earned commission income. It should be credited. They have not credited. What will we do? Credit it. Income alwa. What is it? Isn't it income? Yeah, we'll credit that income of 7,500. Did we receive cash? No. Head office has received commission on behalf of all the branches. They've allocated 7,500 to us. So head office has received the commission on our behalf. We are supposed to collect it from head office. So I will debit head office account debit to 7,500. My income credit 7,500. Head office has collected it on my behalf. So debit head office account 7,500. That's it. 1 mark. 1 entry down. Narration also written. Second one. Head office paid 12,000 directly to one of the branch supplier. I am branch. I purchased goods from somebody. I should pay money. Head office paid money on my behalf. Like you go to the shopping place and you buy something, you tell your parents and then they pay through the scanner, something like that. You have purchased, head office has made the payment. You get it? So when you purchased, you have a creditor in your books. You would have written the journal entry, purchase account debit to creditor. When your head office makes the payment, your creditors will decrease. When the creditors decrease, what do? We debit our creditors because our supplier creditor liability is decreasing. By how much? 12,000. Who paid the money? Head office paid the money. So we are supposed to pay head office. Now we have a liability called head office. Ultimately, head office will keep writing debit, credit, debit, credit, debit, credit. Ultimately, we'll settle the balance. Will not settle, we'll write them in our balance sheet assets or balance sheet liabilities. You are my capital type. Did you understand? Branch will not have capital. Branch will have head office as its capital. Did you understand this entry? Then what do we have after this? This intimation was received by the branch during reconciliation. So branch has not passed, so we did this. Read the third one. Our remittance. Remittance is payment or sending the money of 85,000 is sent by branch to head office. Branch has sent 85,000 to head office. Branch should write the entry cash account credit, head office account debit. We are giving it to head office. Head office debit, our cash is going out credit. Have we written the entry? We have actually written the entry, but has not been received by head office till date. Head office ge hana bandilla naan en madakagutte? I have sent? No, I have written the entry correctly. Head office would have to write the entry cash to branch. If it is not received, instead of writing cash account, they should write cash in transit. Why? If they write cash account, their cash balance should increase. Because they have not received, they should write Sita, cash in transit account debit to branch account. But I have written the entry correctly. I am not going to pass any entry. Here is our question. Ondondu mark. Adarallu ondu no entry. Wow. No entry. No entry. Why? We have given the cash. We have written the entry. Head office has to write cash in transit entry. I am not going to pass any separate entry for this. If head office is not received, it's not my problem. Okay. Number 4. What do we have in number 4? Branch paid 9,800 salary to head office employee. Head office has sent to an employee. He is in the branch now. So what did we do? We paid the salary. Actually, we were supposed to pay. Head office was supposed to pay. When we pay, what is the entry that we should write? Cash account credit. Debit should be head office account. Why? It is not my salary expense. It is head office salary expense. Head office should write salary account debit. I will write cash account credit. They will debit expense. I will make payment. I will debit head office will credit branch. I'll repeat. I have paid money. I will credit cash. I will not debit salary. Why? Not my expense. Head office expense. I should debit head office account debit to cash. I should write the entry as head office account debit to, I have made the payment on behalf of head office. But what has happened? But the amount paid has been wrongly debited to salary. Like lot of creative answers that you people gave wrongly here. They have also debited which account? Salary account. Salary debit madbekitta? No, they should have not debited salary. They have wrongly debited salary. We will credit salary. What were they supposed to debit? Head office. Have they debited head office? No. So now we will debit head office. Sir, this is more like our CA foundation rectification. Yeah, very much like that. So I have paid money on behalf of head office. I was supposed to debit head office account. I have not debited head office. Now I'll debit it. I had wrongly debited it to salary. Now I'll credit salary account to reverse it. Shall we see fifth one? Branch purchased furniture of 18,000 through check. Hey, very good. We purchased furniture. We should write furniture account debit to bank. Why? Paid through check. But the furniture account was maintained by head office. On that furniture, ITC will be there, maintenance will be there, depreciation will be there. Accountant at the branch, no, is not smart enough to pass depreciation entry, ITC accounting and all of this. So what to do? Head office will tell you pay money, but it will get registered in my name. I will keep the asset. In books of accounts, I will keep. Maintenance you do. Usage you do. But books of accounts, whose books of accounts will it be there? Head office. Head office. Usage of the asset, branch. So when you buy the asset, usually journal entry in the books of branch should be, it should be like asset account debit to cash. But we will not write asset to cash. In the place of asset debit, I will write head office to cash. Head office will debit the asset. Head office did not pay cash. No. Head office will write furniture account debit to branch. Branch will write head office account debit to bank. So basically in between that debit credit, if you remove, furniture account debit to bank only. What is the normal journal entry? Furniture to bank. Head office will debit furniture. Branch will credit bank. Branch ಅಲ್ಲಿ credit bank ಇದೆ. Debit will be head office. Head office ಅಲ್ಲಿ debit furniture ಇದೆ. Credit will be branch. Now where are we? In the books of branch. No entry has been passed. So pass the entry. Shall I debit furniture? No. Who debited furniture? Head office furniture debit ಮಾಡಿದರೆ ನಾನು head office debit ಮಾಡ್ತೀನಿ. Head office furniture debit ಮಾಡಿದರೆ I will debit head office. I paid money? Yeah. Cash or check? Check. So I'll debit, I'll credit bank. How much money did I pay? 18,000. I'll write 18,000. Last one, branch has incurred 5,500 expenses on behalf of other branches. I paid money for the sake of other branch. Who should have paid other branch expense? Other branch should have paid. If not other branch, head office should have paid. I have paid. It's not my headache. I have paid other branch expense. Now head office should reimburse it to me. Am I right? I will write cash account or bank account credit. Debit is not my expense. Debit is head office account. This transaction was not recorded in the books of branch. Okay, record it now. Head office account debit to cash or bank, because this money I have paid from my pocket, but it is not my expense. Head office has to pay it to me. I am supposed to recover it from head office, so I have debited head office account. And this is the end of 6 journal entries for 6 marks from branch.